That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving!
Sell it all today.
Look at this thing. It's beautiful.
Welcome to the fucking show.
All right. We are back, everybody. Welcome back. Appreciate everybody hanging out with me. I know there's a lot of competing streams right now, and appreciate that you probably will be jumping around. That's okay. I completely understand. There's a lot going on. There's the normal market close of the MIT. There's Tanner, who is going through earnings as well. And so didn't know Tanner was going live, but that is what it is. And hopefully he does a good job always. So excited to see and watch what he has to come up with afterwards. We got some big numbers coming today. We probably already have numbers coming from Google, it looks like. Let's just get live and right into it. Google already back above $280 a share, back up to $283. Currently in the mooning phase, it looks like. Let's zoom in a little bit here and see what's going on with that. Back up to 281. Looks like, let's check out the numbers on the side here and see what is going on. Let me know what you guys think of the audio. I did some finagling with the mic and downloaded some software, so hopefully that ends up showing up well for you guys. So let's just get into what the third quarter looks like for these guys. So we got the earnings slides. Let's hop into that. Jump right in, actually. Curious to see what it looks like. So 2025 earnings. So the gap. Everyone's changing their fonts these days. Pretty interesting. We just had an interesting conversation about fonts today ourselves. Year-over-year revenue increases of 16%. Net income up 33%, ladies and gentlemen. EPS $2.12 up to $2.87. No wonder why this thing is absolutely moving right now. Alphabet revenues went from 88 billion to 102 billion. That's absolutely insane. Ops margin down slightly. This is something that I was not expecting. I was hoping to go in the opposite direction. I was hoping to go up 32 to 30%. So I'm kind of curious to see when you get to the cloud aspect of things, how does that look? You know, what's going on with that? Curious on that particular piece. Let's see what is going on here. Okay. So Google Network is down 3% year over year. Search is up 15%. Ads from YouTube is up 15%. Subscriptions, platforms, and devices is up 21%. And we can see here operating income, 40% ops margin to 38.5 ops margin. Curious to see what is going on with that. Cloud revenue, holy Jesus Christ. This is what I want to see. The ops margin absolutely exploding from last year, third quarter, to this year, going from 17.1% on the right side of the screen to 23%. Absolutely massive in that respect. Wow. Cloud revenue, we're going to a $15 billion a quarter run rate. That's $60 billion a year. You start to put numbers into that. Let's just assume a 25% ops margin, because these ops margins are getting better. That's $15 billion a year in ops income coming straight from Google. That's pretty impressive. If you ask me, it's one of the main reasons why I started to get invested back into Google many moons ago, because really noticed that they were starting to hit profitability, and profitability they are showing. $3.6 billion in the quarter for operating income. That is impressive. That is more than I was expecting. I was expecting low 22% or so in terms of op income. Capital expenditure up again this quarter, $24 billion in terms of $24 billion in terms of capital expenditure. That's an increase of 83%. And this goes back to the conversation I was having with Steve Fiorillo with respect to, you know, how much more can they raise it, right? 80% year over year. that's pretty expansive. Can they continue down that path? So expansive in that respect. And then the cash flow, you could see, net cash is 50 or so billion, so 58% year over year. So phenomenal from that respect, from 31 billion to 48 or so billion. Trailing 12-month cash flow from a free cash flow perspective, 73 billion, which is huge, right? You take into consideration their massive amount of capex, which is now 20 or so billion for equipment and things of the like. You're ending up at a pretty good run rate, specifically for what you're looking at. 12-month cash flow is just absolutely insane, 73 billion in that respect. But obviously, you're spending a lot in total capex, so that obviously gets impacted pretty substantially. And this is the last slide. This is insane. I was not expecting this. Let's check on the stock really quick. Dear God, my friends, we crossed over $290 a share. Dear God, that is insane in terms of year over year impact. And now we're actually starting to see what Google has been. This is why I was buying in the 140s, 150s and telling people, like, this company is coming to play. The ops margins are here to play. Don't sleep on Google. And here we are. So let's look at this. So 48 billion in terms of cash from operations. And then you have the purchase of equipment, 24 billion. Then you have free cash trailing 12 month of 73.5 billion. That's absolutely insane. Congrats to all the Google shareholders. I am one of them. I realized that I bought some over the past couple months and I didn't even realize it. So congrats to people like me. Unfortunately, I think just because, people are taking some profits, we're down to 287, 288 or so. We did peak out at one point at over almost 295. So congrats to the people that have purchased into Google. Absolutely insane. Maybe we're going to see some other numbers. Okay, let's curious now. What other companies have reported? I assume Meta has also reported. Meta down, ladies and gentlemen, 7, almost going on 8% below. This could be an opportunity for those people that might be looking. Google outperforming very well. Meta down pretty substantially. That's insane. That is insane in terms of what is going on for them. Let me just make sure. Yeti got these speakers. Okay, we're good. So I'm curious, what's actually going to happen with Meta into this earnings report? Let's pull up their particular numbers. Meta Investor Relations. Let's look at their earnings. So have they given out yet their deck? So they got the press releases out. View all press releases. So here's the press releases. I'm curious if they have a deck. I'd rather see a deck, but we can just go through the numbers themselves here. Appreciate the 8 of you hanging out with me while we go through this. Let's see here. Revenue up expansively, 26% year-over-year revenue growth. 32% costs are up, so that's probably a prime reason as to why people are getting a little bit frustrated. So costs are up a little bit. So that could be a key piece, but income overall up 18%. So I think that might be a key reason why people are a little bit fearful. Meta still below $700 a share as of the speech that I'm talking right now. And this is, ops margin increasing 40 to 43%. But yeah, slowing down, I guess, in terms of total pace. Costs and expenses going up pretty drastically. Let's see. But EPS growing or sorry, EPS going down, way down. Sorry, no, ops. Sorry, I'm losing it. Ops margin going down from 43% to 40%. Net income, massive impact, 16 billion to 2.7 billion. We'll have to read what exactly is going on. It looks like it's for income tax reasons, because the income tax went up to 87% comparatively 12%. I don't know if anybody saw that coming, but it looks like right now, based off of this, people that are playing in the after hours, it looks like Meta is now coming back up for air comparatively to where we were. So interesting in that respect. But what the heck is going on here? So we expect a significant reduction in our U.S. federal cash tax payments for the remainder of 25 and for future years due to the implementation of the One Beautiful Bill Act. I wonder if people knew about this. However, the implementation has also led to the recognition of valuation against our U.S. federal tax assets, reflecting the U.S. corporate alternative minimum tax. As a result, the third quarter provision for income tax included a one-time non-cash income tax charge of $15.93 billion. Excluding this one time, our third quarter 2025 effective tax rate would have decreased by 73 percentage points to 14% compared to the 12% that it was, compared to the reported 87%. For this particular quarter. Net income would have increased by just under 16 billion to 18 billion. So you would have gone from a net income of 15.6 to 18.6. So an increase of 3 billion. So just under 18%, it looks like, in terms of increase in total net income. And that would have been, pretty expansive. So diluted EPS would have increased to $6.20. By $6.20 to $7.25, compared to what it shows up as is $1.05. So it would have went up to $7.25 from $6. So yeah, EPS would have gone up 20 or so percent, which I assume likely is because of buybacks. So let's talk about some other financial metrics that they might be having. So daily active people, 3.5 billion, an increase of 8% year over year. Ad impressions across a family of applications up 14%. Average price per ad up 10%. Revenue up 26%. On a currency constant basis would have been 25%. And costs and expenses were 30.7, which is an increase of 32%. That's a big thing to consider. Revenue's going up, but expenses are going up even faster. CapEx, that's why ops margins are down from 42% to 40%. CapEx, including principal payments, were 20 billion for the quarter. Capital returns, so they purchased about 3.16 billion for Class A common stock, and dividends equivalent to 1.33 billion. So pretty good dividend payouts, actually, just over 5 billion. For Facebook at this point, even though it's a minimal dividend. You think about how large these companies are, even a small dividend ends up being a large amount. Meta at about $704 a share right now, 5% down still. They had about 44.5 billion on hand as of the end of the third quarter, and ops cash flow was $30 billion. Free cash flow was 10.6. How you get the free cash flow? You take this 30 billion and you subtract out the capital expenditure. That's that. Increase of headcount of 8% year over year. So interesting to hear what the updates are for the fourth quarter. So revenue was 51 billion for this quarter. So CFO outlook specifically for the fourth quarter. So 56 to 59 billion. Assumes foreign currency of approximately 1% for the tailwind. Total expenses 116 to 118, which is up from 114 to 118. So that increases growth rate about 22 to 24%. They expect CapEx to increase to 70 to 72 billion from 66 to 72 billion. So the upper half of that range. And then tax rate excluding the one-time hit that they had in the third quarter. So it looks like it goes back to normal next quarter. 12 to 15%. So more normal and in line with what it would have been without this one-time tax. 87% tax rate for the third quarter, ladies and gentlemen. Meta going back to the opposite direction, $702 a share. So curious to see what they talk about. That call is in 15 minutes. The Alphabet call, let's see what they're, I think that's also at the same time. Doesn't say. I assume that's at the same time. Let's see. Yeah, 2:30, and that's on YouTube. That one's easy. All right, Microsoft. Where's Microsoft? Microsoft also reporting today. It's a big day. As I type, Meta goes below $700 a share. Microsoft retracing as well. Down $3, 3.5% after hours. Impressive. I don't know what's potentially going on with some of these things. I'm curious if they also had an impact due to the one-time tax. Let's see. Microsoft Investor Relations. What I'm seeing right now, returning, so let's call earnings call slides, and they will be live. Does it say when they'll be live? 2:30 Pacific, so 5:30 Eastern. Okay, so it looks like, am I losing it? I think I'm losing it. So luckily we'll be able to listen to Meta. Meta's at 4:30 Eastern. So in 12 minutes. And it looks like Google and Microsoft are competing. So let's take a look through some of the Microsoft numbers here. I don't know what's going on with why the what's going on at the top, but it is what it is. Microsoft needs to get their shit together. Oh, wait. This is the previous. So is Microsoft not out yet? Hold on a sec. There we go. Let me just double check that webcast is, 5:30 Eastern. So luckily we'll be able to listen to Meta in 10 minutes. And then we'll listen to Google. I'm prone to want to listen to Google personally, but let's put it at a poll in the chat specifically around what you guys want to listen to, because technically, even though it's my show, I have to listen to you guys. Engage with the audience, start a poll. Would you rather listen to MST or Google earnings? MSFT, and the other one would be Google. All right. So we unfortunately have to choose. So I appreciate you guys making that decision. I know which one I personally want to look at. So anyway, let's get into these numbers. October 29th, 2025. I personally just want to dive into the slide pack. Is that okay? Is that okay, guys? Let's dive into the slide pack. Let's see what it pulls up. Taking a minute. It's taking a minute, ladies and gents. What the heck? All right, well, that's pulling up. Oh, can't be reached. Come on now. All right, we'll see what happens with that. In the meantime, we'll read this. I'll open up my non-sponsored energy drink. Revenue was 77.7, up 17% on a constant currency basis. Operating income up 22%. That's what we want to see. We don't see what happened with Meta, where you're up however much, but your earnings or your expenses were also up like huge. You don't want to see that. You want to see this 17% and 22% for revenue and operating income, respectively. Like, you want to see your operating income expanding faster. Net income on a GAAP basis was 27.7 billion, increased 12%. On non-GAAP basis, increased 21% on a constant currency, up to $31 billion. Diluted EPS on GAAP was $3.72, increasing 13%. And on a non-GAAP, increased 21% constant currency at $4.13. This excludes the impact from investments in OpenAI, explained in the non-GAAP definition. Satya Nadella says, our Planet scaled cloud and AI factory together with co-pilots across high-value domains is driving broad diffusion and real-world impact. It is why we continue to increase our investments in AI across both capital and talent to meet the massive opportunity ahead. We delivered a strong start to the fiscal year, exceeding expectations across revenue, operating income, and earnings per share, said the CFO and executive vice president. Continued strength in the Microsoft Cloud reflects the growing customer demand for our differentiated platform. And let's get into some of the numbers. So, let's see. 24 verse 27, up 12%. AI impact was 3 billion. That's pretty crazy. So non-GAAP, you go from 25 to 30, which is pretty insane. That's where that 21% constant currency comes through. So business highlights. This is where it kind of gets juicy, ladies and gentlemen. So the Microsoft Cloud business was up 49%. Now keep in mind, 49 billion. Keep in mind, Google was at $15 billion run rate per the quarter. This is at a 49 billion. It's a $200 billion run rate for cloud for one segment of their business. This isn't specifically enterprise. Interesting. Let's see what the poll says. Everyone says Google, so we're listening to Google, which is good because I want to watch Google. So we'll have that up there. We'll continue to see, but yeah, can you believe that? $200 billion. So that's up 25% constant currency. Commercial obligations remaining is 392 billion. So that's pretty good. That's up 51%. Meaning people are signing up more and more for extended items. Microsoft still down 3.5% here. Can't believe it's in the 500s. Let's check on the S&P 500 after hours, knowing that we kind of have some interesting up downs. 685, so we're kind of even for the day, if you consider that even. I would. 288 on Alphabet, which is great. Let's see how Meta is now getting back after it. Meta is continuing its move downwards to below 690. This is good. I would take a one-time tax item to give me the opportunity to buy Meta at a decent or more decent valuation. If this persists and people downgrade the stock, it might be the opportunity to enter. I need to look more into the numbers, but I hope it continues to accelerate downwards. I say that tongue in cheek because obviously I know some of you guys are invested in Meta. I don't want anybody to lose money. I think it's a short term for the people that might be panicking. I think that is a short-term impact. You think if things get changed in the opposite direction and a different administration, that's a positive upright potentially. Because generally when these things sorts of happen, when you have these large write-downs, this is out for like several years, right? And so that 18 billion, you know, 87% tax rate, that's not just 1 year's worth of write-downs. That's several years worth of write-downs and taxes. So, all right, getting back to Microsoft. Sorry to jump around on you guys, but we're about 4 minutes away from the Meta call. So in the background, let me make sure that I get that up and running as well. Press releases home. Third quarter results. Oh, there it is. Webcast. Not sharing. Okay. Register with Q4. All right. We are prepared. So whatever that gets going. All right. Microsoft 365 up 15%, Consumer Cloud up 25%, LinkedIn up 9% constant currency, Dynamics 365 up 16%, Intelligent Cloud up 31 billion, was up to 31 billion, and increased 27% constant currency. Azure and Cloud up 40%, 39% in constant currency. Absolutely amazing. Both Google and I'm curious now to see Amazon. Because like if Google, I have to compare. So like obviously Microsoft blew it out of the wazoo for cloud, but Google, we really got to check. So it did well, right? And the ops margin continued to do well, but we don't have the details specifically on Microsoft. Maybe between Meta call and before the start of the Google Microsoft, we can look specifically at the income percentages because there's a lot of revenue chat, but not so much on the ops margins and everything from each. Personal computing was 13.8 billion, increased 4%. Windows and OEM and devices increased 6%. Xbox relatively unchanged on a constant currency. Search and news advertising up 15%. That's interesting. Not a lot of people. I need to start like comparing Amazon, Google, and Microsoft for their advertising businesses. Microsoft returned $10.7 billion to shareholders in the form of dividends and repurchases in the first quarter of 2026, which is absolutely phenomenal. We'll have Satya, Amy Hood, and Alice on the earnings call, but we'll be listening to Google likely. So let's see, did they split it out? Microsoft Cloud. They split up cloud. So this is all revenue. Costs. Yeah, so unfortunately they don't split it out. Here we go. Product and businesses. So I'm curious of their cloud margins. Intelligent Cloud, 30 billion, 13.4 billion. So that's like what, 40%? Sorry, I'm going to do some math, guys. 13.4 divided by 30.1. Sorry, it should have been 31. 13.4 divided by 31. 43% ops margins. So you think about it, like Google's only at 23, right? And a lot of that's because they haven't fully been able to offset all their SG&A and everything like that. In that particular part of the business. Cautiously optimistic, you'll get above 40% in Google as well. And that's increasing 20-something%. So doing well. But Azure is continuing to dominate in that respect. Personal computer, 4 billion out of 13.8. That's still pretty healthy. It's like what, 25%? 4.2 divided by 13.75, 30 on the dot pretty much. So overall ops margins are what? 0.9. 37.96 divided by 77.67, 49% ops income margins. That is huge. That's insane. We're just waiting for Meta to get us going, guys. Let me know if you can hear the background music. One's in the chat if you can hear the background music. Oh, here we go.
Good afternoon. My name is Krista, and I will be your conference operator today. At this time, I would like to welcome everyone to the Meta third quarter earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. To withdraw your question, again, press star 1. We ask that you limit yourself to one question, and this call will be recorded. Thank you very much. Kenneth Dorell, Meta's Director of Investor Relations, you may begin.
Thank you. Good afternoon and welcome to Meta's third quarter 2025 earnings conference call. Joining me today are Mark Zuckerberg, CEO, and Susan Li, CFO. Our remarks today will include forward-looking statements which are based on assumptions as of today. Actual results may differ materially as factors, including those set forth in today's earnings press release filed with the SEC. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and an accompanying investor presentation are available on our website at investor.meta.com. And now I'd like to turn the call over to Mark.
All right, thanks, Ken. Thanks, everyone, for joining today. We had another strong quarter with 3.5 billion people using at least one of our apps every day. Instagram hit a major milestone with 3 billion monthly actives, and we're seeing good momentum across our other apps as well, including Threads, which recently passed 150 million daily actives and remains on track to become the leader in its category. I am very focused on establishing Meta as the leading frontier AI lab, building personal superintelligence for everyone, and delivering the app experiences and computing devices that will improve the lives of billions of people around the world. Our approach of advancing open source AI means that when Meta innovates, everyone benefits. Meta Superintelligence Labs is off to a strong start. I think that we've already built the lab with the highest talent density in the industry. We're heads down developing our next generation of models and products, and I'm looking forward to sharing more on that front over the coming months. We're also building what we expect to be an industry-leading amount of compute. Now, there's a range of timelines for when people think that we're going to get superintelligence. Some people think that we'll get there in a few years. Others think it will be 5, 7 years or longer. I think that it's the right strategy to aggressively front-load building capacity so that way we're prepared for the most optimistic cases. That way, if superintelligence arrives sooner, we will be ideally positioned for a generational paradigm shift and many large opportunities. If it takes longer, then we'll use the extra compute to accelerate our core business, which continues to be able to profitably use much more compute than we've been able to throw at it. And we're seeing very high demand for additional compute, both internally and externally. And in the worst case, we would just slow building new infrastructure for some period while we grow into what we build. The upside is extremely high for both our existing apps and new products and businesses that are becoming possible to build. Across Facebook, Instagram, and Threads, our AI recommendation systems are delivering higher quality and more relevant content, which led to 5% more time spent on Facebook in Q3 and 10% on Threads. Video is a particular bright spot, with video time spent on Instagram up more than 30% since last year. And as video continues to grow across our apps, Reels now has an annual run rate of over $50 billion. Improvements in our recommendation systems will also become even more leveraged as the volume of AI-created content grows. Social media has gone through two eras so far. First was when all content was from friends, family, and accounts that you followed directly. The second was when we added all of the creator content. Now, as AI makes it easier to create and remix content, we're going to add yet another huge corpus of content on top. Meaningful advances from unifying different models into simpler, more general models, which drive both better performance and efficiency. And now, the annual run rate going through our completely end-to-end AI-powered ad tools has passed $60 billion. Now, one way that I think about our company overall is that there are three giant transformers that run Facebook, Instagram, and ads recommendations. We have a very strong pipeline of lots of ways to improve these models by incorporating new AI advances and capabilities. And at the same time, we are also working on combining these three major AI systems into a single unified AI system that will effectively run our family of apps and business using increasing intelligence to AI, and I think that the opportunity there is very large. The same goes for our business AI. Every day, people have more than 1 billion active threads with business accounts across our messaging platforms, ranging from product questions to customer support. Our business AIs will enable tens of millions of businesses to scale these conversations and improve their sales at low cost. And the better our models get, the better this is going to work for all businesses. This quarter, we also launched Vibes, which is the next generation of our AI creation tools and content experiences. Retention is looking good so far, and its usage keeps growing quickly week over week. I'm looking forward to ramping up the growth of Vibes over the coming months. More broadly, I think that Vibes is an example of a new content type enabled by AI, and I think that there are more opportunities to build many more novel types of content ahead as well. As our new models become ready, I'm looking forward to starting to show everyone some of the new kinds of products that we're working on. At Connect, we announced our 2025 line of AI glasses, and the response so far has been great. The new Ray-Ban Meta glasses and Oakley Meta Vanguards are both selling well, as people love the improved battery life, camera resolution, new AI capabilities, and the great design. And there's our new Meta Ray-Ban display glasses, our first glasses with a high-resolution display and the Meta Neural Band to interact with them. They sold out in almost every store within 48 hours, with demo slots fully booked through the end of next month. So we're going to have to invest in increasing manufacturing and selling more of those. This is an area where we are clearly leading and have a huge opportunity ahead. Taking a step back, if we deliver even a fraction of the opportunity ahead for our existing apps and the new experiences that are possible, then I think that the next few years will be the most exciting period in our history. We've got a lot to do, but we're making real progress, delivering strong business results, building the talent density and infrastructure needed for the next era, and leading the way on AI devices that will define the next computing platform. I'm proud of how our teams are rising to the challenge, and I'm grateful for their dedication, hard work, and creativity. As always, thank you all for being a part of this journey with us. And now, here's Susan.
Thanks, Mark, and good afternoon, everyone. Let's begin with our segment results. All comparisons are on a year-over-year basis unless otherwise noted. Our community across the family of apps continues to grow, and we estimate more than 3.5 billion people used at least one of our family of apps on a daily basis in September. Q3 total family of apps revenue was $50.8 billion, up 26% year over year. Q3 family of apps ad revenue was $50.1 billion, up 26%, or 25% on a constant currency basis. In Q3, the total number of ad impressions served across our services increased 14%. Impression growth was healthy across all regions, driven by engagement and user growth, particularly on video surfaces. The average price per ad increased 10% year over year, benefiting from increased advertiser demand, largely driven by improved ad performance. This was partially offset by impression growth, particularly from lower monetizing regions and surfaces. Family of Apps other revenue was $690 million, up 59%, driven by WhatsApp paid messaging revenue growth, as well as Meta verified subscriptions. Within our Reality Labs segment, Q3 revenue was $470 million, up 74% year over year. The significant year-over-year growth in Q3 was partly due to retail partners stocking up on Quest headsets ahead of the holiday season. We did not have a similar benefit in the third quarter of last year, since our Quest 3S headset launched in the fourth quarter of 2024. Aside from this, strong AI glasses revenue also contributed to revenue growth in Q3. Moving now to our consolidated results. Q3 total revenue was $51.2 billion, up 26% or 25% on a constant currency basis. Q3 total expenses were $30.7 billion, up 32% compared to last year. Year-over-year expense growth accelerated 20 percentage points from Q2, due primarily to three factors. First, legal-related expense growth was higher than in Q2, due to charges we recorded in the third quarter, as well as us lapping a period of accrual reversals in the third quarter a year ago. Second, employee compensation growth accelerated, driven by technical hires, particularly AI talent. Finally, growth in infrastructure costs accelerated due to increased infrastructure operating costs associated with our expanded data center fleet, depreciation on our incremental CapEx spend, and third-party cloud spend. We ended Q3 with over 78,400 employees, up 8% year over year, driven by hiring in priority areas of monetization, infrastructure, Reality Labs, Meta Superintelligence Labs, as well as regulation and compliance. Third quarter operating income was $20.5 billion, representing a 40% operating margin. Q3 interest and other income was $1.1 billion, driven primarily by unrealized gains on our marketable equity securities. Our tax rate for the quarter was 87%, which was unfavorably impacted by a one-time non-cash reduction in deferred tax assets that we no longer anticipate using under new U.S. tax law. Our tax rate would have been 14%, excluding this charge. Although the transition to the new U.S. tax law resulted in an accounting charge in the third quarter, we continue to expect we will recognize significant cash tax savings for the remainder of the current year and future years under the new law, and this quarter's charge reflects the total expected impact from the transition to the new U.S. tax law. Net income was $2.7 billion, or $1.05 per share. Excluding the one-time tax charge, our net income and EPS would have been $18.6 billion and $7.25 per share, respectively. Capital expenditures, including principal payments on finance leases, were $19.4 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $10.6 billion. We repurchased $3.2 billion of our Class A common stock and paid $1.3 billion in dividends to shareholders. We ended the quarter with $44.4 billion in cash and marketable securities and $28.8 billion in debt. Turning now to the business outlook, there are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, daily actives continue to grow year over year across Facebook, Instagram, and WhatsApp. We're continuing to see improvements to our products and recommendations drive incremental engagement, with year-over-year growth in global time spent accelerating on both Facebook and Instagram in Q3. In the US, overall time spent on Facebook and Instagram grew double digits year over year, driven by continued video strength as well as healthy growth in non-video time on Facebook. The engagement gains continue to be driven by product work and ongoing improvements to our recommendation systems as we optimize our model architectures, implement advanced modeling techniques, and integrate more signals about people's interests. We also continue to focus on increasing the freshness of recommended content. On Facebook, our systems are now surfacing twice as many reels published that day than at the start of the year. Looking to 2026, we expect to advance our recommendation systems across several dimensions. On Instagram, one focus is evolving our systems to surface content across a broader set of topics that cater to the diverse interests of each person. This follows a similar approach we've implemented on Facebook that has driven good results. We also expect to make significant progress on our longer-term ranking innovations in 2026. We're seeing promising new results from our research efforts to create foundational ranking models and expect the new model innovations we're developing as part of this will enable us to significantly scale up the amount of data and compute we use to train our recommendation models in 2026, yielding more relevant recommendations. Another large focus next year is leveraging LLMs to improve content understanding. We expect this is going to enable our systems to more precisely label the keywords and topics within videos and posts, which will allow our systems to both develop deeper intuition about a person's interests and retrieve the content that matches them. Finally, we're making good progress with Meta AI and Threads. The number of people using Meta AI across our family of apps continues to grow, and we're increasingly leveraging first-party content into Meta AI results, with the majority of Meta AI's responses to Facebook deep dive queries in the US now showing related reels. We're also seeing a lot of traction with media generation. People have created over 20 billion images using our products, and since launching Vibes within Meta AI in September, we've seen media generation in the app increase more than tenfold. On Threads, we see strong growth in both daily actives and the depth of engagement as we continue to improve recommendations. The ranking optimizations we made in Q3 alone drove a 10% increase in time spent on Threads. We also continue to ship new features, including launching direct messaging in Q3, so anyone on Threads can now message one another within the app. Now to the second driver of our revenue performance, increasing monetization efficiency. The first part of this work is optimizing the level of ads within organic engagement. We continue to refine ad supply across each of our major surfaces within Facebook and Instagram to better deliver ads at the time and place they are most relevant to people. Longer term, we have exciting ad supply opportunities on both Threads and WhatsApp Status. Ads are now running globally in feed on Threads, and we're following our typical monetization playbook of optimizing the ads formats and performance before we ramp supply. Within WhatsApp Status, we're continuing to gradually introduce ads and expect to complete the rollout next year. The second part of increasing monetization efficiency is improving marketing performance. Advancing our ad systems remains a critical aspect of this work, and we are driving performance gains through ongoing improvements in our larger scale ads ranking models. For example, we continue to broaden the adoption of Lattice, our unified model architecture. In Q3, we rolled out Lattice to app ads, which drove a nearly 3% gain in conversions for that objective. Since introducing Lattice back in 2023, along with other backend improvements, we have now cut the number of ads ranking and recommendation models by approximately 100, as we consolidated smaller and more specialized models into larger ones that use the Lattice architecture to generalize learnings across surfaces and objectives. We continue to observe performance improvements as we combine models and expect to drive additional gains as we consolidate another 200 models over the coming years into a smaller number of highly capable models. In addition to advancing our foundational ads models, we're innovating on our runtime models we use downstream of them for ads inference. For example, we began piloting a new runtime ads ranking model in Q3 that leverages more compute and data than our prior models to select more relevant ads. In testing, we've seen this new model drive a more than 2% lift in conversions on Instagram. We also significantly improved performance of Andromeda in Q3 by combining models across retrieval and early stage ranking into a single model, driving a 14% increase in ads quality on Facebook surfaces. Within our ads products, we're seeing continued momentum with Advantage Plus. In Q3, we completed the rollout of our streamlined campaign creation flow for Advantage Plus lead campaigns. So now advertisers running sales, app, or lead campaigns have end-to-end automation turned on from the beginning, allowing our systems to look across our platform to optimize performance by automatically choosing criteria like who to show the ads to and where to show them. The annual run rate of revenue running through our end-to-end automated solutions has now reached $60 billion following the implementation of the new streamlined creation flow, as we continue to see more advertisers leverage the performance benefits of our solutions. Within our Advantage Plus Creative Suite, the number of advertisers using at least one of our video generation features was up 20% versus the prior quarter, as adoption of image animation and video expansion continues to scale. We've also added more generative AI features to make it easier for advertisers to optimize their ad creatives and drive increased performance. In Q3, we introduced AI-generated music, so advertisers can have music generated for their ad that aligns with the tone and message of the creative. Finally, business messaging remains a significant opportunity for us. We're seeing strong growth across our portfolio of solutions, including with click-to-WhatsApp ads, which grew revenue 60% year over year in Q3. We're also making good progress on our business AI efforts, where we've been focused on building a turnkey AI that helps businesses generate leads and drive sales. We've been opening access in recent months to more businesses within our initial test markets, the Philippines and Mexico, and have seen strong usage with millions of conversations between people and business AIs taking place since July. This month, we expanded availability within WhatsApp and Messenger to all eligible businesses in Mexico and the Philippines, respectively. In the US, we're also starting to roll out the ability for merchants to add their business AIs to their website so we can support the full sale funnel from ad to purchase. Next, I would like to discuss our approach to capital allocation. Our primary focus is deploying capital to support the company's highest order priorities, including developing leading AI products, models, and business solutions. As we make significant investments in infrastructure to support this work, we are focused on preserving maximum long-term flexibility to ensure we can meet our future capacity needs while also being able to respond to how the market develops in the years ahead. We're doing so in several ways, including staging data center sites so we can spring up capacity quickly in future years as we need it, as well as establishing strategic partnerships that give us option value for future compute needs. The strong financial position and cash generation of our business enable us to make these investments while also accessing additional pools of cost-efficient capital. Moving to our financial outlook, we expect fourth quarter 2025 total revenue to be in the range of $56 to $59 billion. Our guidance assumes foreign currency is an approximately 1% tailwind to year-over-year total revenue growth based on current exchange rates. Our outlook reflects an expectation for continued strong ad revenue growth, partially offset by lower year-over-year Reality Labs revenue in Q4. The anticipated reduction in Reality Labs revenue is due to us lapping the introduction of Quest 3S in Q4 of last year, as well as retail partners procuring Quest headsets during Q3 of this year to prepare for the holiday season, which were recorded as revenue in the third quarter. Turning to the expense and CapEx outlooks, I'll first start with 2025 before providing some commentary on our planning for 2026. We expect full year 2025 total expenses to be in the range of $116 to $118 billion, updated from our prior outlook of $114 to $118 billion, and reflecting a growth rate of 22 to 24% year over year. We currently expect 2025 capital expenditures, including principal payments on finance leases, to be in the range of $70 to $72 billion, increased from our prior outlook of $66 to $72 billion. On to tax. Absent any changes to our tax landscape, we expect our fourth quarter 2025 tax rate to be 12 to 15%. Turning now to 2026. We are at an exciting point for our company, where we have continued runway to improve our core services today, as well as the opportunity to build new AI-powered experiences and services that will transform how people engage with our products in the future. We expect the set of investments we're making within our ads and organic engagement initiatives next year will enable us to continue to deliver strong revenue growth in 2026, while our progress on AI models and products will position us to capitalize on new revenue opportunities in the years to come. A central requirement to realizing these opportunities is infrastructure capacity. As we have begun to plan for next year, it's become clear that our compute needs have continued to expand meaningfully, including versus our own expectations last quarter. We are still working through our capacity plans for next year, but we expect to invest aggressively to meet these needs, both by building our own infrastructure and contracting with third-party cloud providers. We anticipate this will provide further upward pressure on our CapEx and expense plans next year. As a result, our current expectation is that CapEx dollar growth will be notably larger in 2026 than 2025. We also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth primarily driven by infrastructure costs, including incremental cloud expenses and depreciation. Employee compensation costs will be the second largest contributor to growth, as we recognize a full year of compensation for employees hired throughout 2025, particularly AI talent, and add technical talent in priority areas. Finally, we continue to monitor active legal and regulatory matters, including the increasing headwinds in the EU and the US that could significantly impact our business and financial results. For example, in the EU, we continue to engage constructively with the European Commission on our less personalized ads offering. However, we cannot rule out the Commission imposing further changes to that offering that could have a significant negative impact on our European revenue as early as this quarter. In the US, a number of youth-related trials are scheduled for 2026 and may ultimately result in a material loss. In closing, this was another good quarter for our business. We have an exciting set of opportunities to continue improving our core business while delivering innovative new experiences and services for the people and businesses using our products in the years to come. With that, Krista, let's open up the call for questions.
Thank you. We will now open the lines for a question and answer session. To ask a question, please press star 1 on your touch-tone phone. To withdraw your question, again, press star 1. Please limit yourself to one question. Please pick up your handset before asking your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And your first question comes from the line of Brian Nowak with Morgan Stanley. Please go ahead.
Thanks for taking my questions. I have two for Susan. The first one, Susan, so the pipeline for core improvements to come in 26 with models and ad ranking models and more types of compute seems very exciting, and the infrastructure build seems sizable behind that. So can you help us a little understand some of the early quantifiable signals you're seeing on A/B tests from some of these improvements to come that sort of make you most excited and give you confidence you're going to get ROIC from all this CapEx? That's the first one. Second one's a little faster. How how large is the Reality Labs revenue headwind in the 4Q guidance? Thanks.
Thanks, Brian, for the question. I think your first question had a couple parts to it, so I'm going to try to disaggregate those parts and let me know if this addresses what you're getting to. I will say that the growth in 2026 CapEx relative to 2025 comes from growth in each of the core areas, MSL, core AI, as well as non-AI spend. So all of those areas are growing, but the MSL AI needs are growing the most. In terms of the core AI pipeline, I think we talked about last year when we were going into the 2025 budget process, we had a roadmap of resource investments across both headcount and compute that we thought would pay off, in 2026. And it's really a very broad range of sort of different ads, ranking and performance efforts. And we're continuing to see that, those have paid off through the course of the year. There is a long list of specific efforts, but one of the measures that we look at to monitor this is how are we driving ad performance? How are conversions growing? Conversions is a complex metric for us because advertisers optimize for so many different conversions on different values. But when we control for that and look at value-weighted conversion rates, we're seeing very strong year-over-year growth, and weighted conversions continue to grow faster than impressions. We also talked about some of the new model architecture over the course of the year and the degree to which the new model architecture is enabling us also to take advantage of having more data and more compute to drive ads performance. So we expect that that's going to be a continued story in 2026. We are, in fact, at the beginning of our 2026 budgeting process now, and we, see a similar list of revenue investments that we're excited to be able to invest in. And so we think that that's going to be a big part of our ability to continue to drive strong revenue performance throughout the year. On your second question, which is the Reality Labs revenue headwind, I don't think we have quantified the exact size of that. We expect that Q4 Reality Labs revenue will be lower than last year for a couple reasons that I alluded to. The biggest factor is we're lapping the introduction of Quest 3S in Q4 of last year, and we don't have a new headset in the market this year. We also recorded all of our holiday-related Quest 3S sales in Q4 24 since the headset was launched in October 24. This year, we're recognizing some of those Quest 3S sales in Q3 as retail partners have procured Quest headsets in advance of the holiday season. We're still expecting significant year-over-year growth in AI glasses revenue in Q4 as we benefit from strong demand for the recent products that we've introduced, but that is more than offset by the headwinds to the Quest headsets.
Your next question comes from the line of Doug Anmuth with JP Morgan. Please go ahead.
Great. Thanks for taking the question. I appreciate the strategy to front load capacity for superintelligence. Can you just talk about your thought process in kind of triangulating the CapEx dollar growth and the significantly faster expense growth next year with core growth in the business and then the impact on earnings and free cash flow? And do you have targets that we should be thinking about for cash on hand or net cash overall? Thanks.
Thanks, Doug. We're right now, I would say, in the process we're relatively early, actually, still in the process of putting together our budget for 2026. And it is on the capacity side a particularly dynamic process. We're certainly seeing that we wish we had more capacity today than we do. We would be able to put it towards good use. Not only would the MSL team appreciate having more capacity, but we'd be able to put it towards good and ROI positive use in the core business as well. So we're really trying to plan ahead, not only to ensure that we have the capacity we need in 2026, but also to give ourselves the sort of flexibility and option value to have the capacity that we think we could need in 27 and 28. So that said, there are lots of moving pieces in the budget. It's not baked yet. It's still sort of in the process of coming together. We don't have, specific targets to share, but we do feel like, our strategic priority is really making sure that we have the compute that we need to be well positioned to succeed at AI. And, that's sort of the foremost priority as we're putting together the budget.
Yeah, I mean, I'll add a few thoughts on this too, although as Susan said, we're still working through the actual budget, and I think we'll typically have more to share on that early next year. But to date, we keep on seeing this pattern where we build some amount of infrastructure to what we think is an aggressive assumption, and then we keep on having more demand to be able to use more compute, especially in the core business, in ways that we think would be quite profitable, than we end up having compute for. So I think that suggests that being able to make a significantly larger investment here is very likely to be a profitable thing over some period, because if the primary use of it is going to be to accelerate the AI research and the new AI work that we're doing and how that relates to both the core business and new products. But any compute that we don't need for that, we feel pretty good that we're going to be able to absorb a very large amount of that to just convert into more intelligence and better recommendations in our family of apps and ads in a profitable way. Now, I mean, it's of course possible to overshoot that, right? And if we do, I mean, this is what I mentioned in my comments, then, we see that there's just a lot of demand for other new things that we would build internally, externally. Like almost every week, people come to us from outside the company asking us to stand up an API service, or asking if we have different compute that they could get from us. And we haven't done that yet, but obviously if you got to a point where you overbuilt, you could have that as an option. And then the kind of the very worst case would be that we effectively have just pre-built for a couple of years, in which case, of course, there would be some loss and depreciation, but we'd grow into that and use it over time. So my view on this is that rather than continuing to be constrained on CapEx and feeling in the core business like we have significant investments that we could make that we're not able to make that would be profitable, that the right thing to do is to try to accelerate this to make sure that we have the compute that we need, both for the AI research and new things that we're doing, and to try to get to a different state on our compute stance on the core business. So that's kind of how I'm thinking about that overall. Of course, there's a lot of operational constraints too on what one can build, right? So we're basically trying to work through this all, and I think we'll have more to share in the coming months and over the course of next year. But I think that there's just a huge amount of opportunities ahead here.
Your next question comes from the line of Eric Sheridan with Goldman Sachs. Please go ahead.
Thanks so much for taking the question. Mark, wanted to reflect on some of your comments with respect to scaling towards superintelligence and bringing it back to consumer AI. Maybe reflect a little bit on the signals you've gotten on the way consumers across family of apps interact with Meta AI today, and how you think about scaling and exiting models from the superintelligence effort might change the utility and behavior around Meta AI in the years ahead. Thanks.
Yeah, I mean, a lot of people use Meta AI today. I mean, as I said in my comments up front, there's more than 1 billion people who use it on a monthly basis. And what we see is that as we improve the quality of the model, primarily for post-training Llama 4 at this point, we continue to see improvements in usage. So our view is that when we get the new models that we're building in MSL in there and get like truly frontier models with novel capabilities that you don't have in other places, then I think that this is just a massive latent opportunity, right? We know, I mean, I would guess that, Meta, I think, has the best track record of any company out there of taking a new product that people love and getting it to billions of people in terms of usage. So I think that the ability to plug in leading models is going to, I would predict, lead to a very large amount of use of these things over the coming years. So I'm very excited about that in terms of new products. It's not just Meta AI as an assistant. I think that there are going to be all kinds of new products around different content formats, and we're starting to see that with video and content creation. But I think that there's going to be a lot more like that I'm quite excited about. And then there are the business versions of all of these too, like business AI, and then that's of course one part of the story is the new things that will be possible to build, and then the other part is how more intelligent models are just going to improve the core business and improve the recommendations that we make across the family of apps and improve the recommendations in advertising. And I think there's just as we've shown, there's sort of this very large amount of headroom, and the opportunity there keeps growing as we as we are improving and optimizing the AI there. And I think that really shows no sign of being near the end. I think that there's quite a bit more to do there. And like I said in response to the last question, we are sort of perennially operating the family of apps and ads business in a compute starved state at this point, which is on the one hand sort of an odd thing to say given the compute that we've built up, but we really are taking a lot of the resources and using them to advance future things that we're doing, and we think that there's a lot more compute that we could put towards these that would just unlock a huge amount of opportunity in the core business as well.
Your next question comes from the line of Mark Shmulik with Bernstein. Please go ahead.
Yes, hi, thanks for taking the questions. Susan, as you think about the visibility into kind of the runway next year of continued ad performance and engagement improvements, how do you think about kind of the scale of those improvements versus kind of the progress we've seen over the last 2 years? And then Mark, as you think about kind of the timing of some of these newer efforts coming out of Superintelligence Labs, is us anchoring to kind of an updated frontier model launch sometime next year like the right way for us to think about it? Or should we be looking at kind of progress from new products you're excited to see ship like Vibes? Thank you.
Thanks, Mark. So on the sort of ads improvement side, some of the innovations that we have been launching actually involve sort of improving our larger scale models. So we, don't use our larger model architectures like GEM for inference because their size and complexity would make it too cost prohibitive. The way that we drive performance from those models is by using them to transfer knowledge to smaller, lightweight models that are used at runtime. And then in addition to the foundation model work, we are working on advancing our inference models by developing new techniques and architectures that then allow us to scale up compute and complexity in an ROI positive way. So in general, we obviously have a very large base of advertisers. There's a lot of demand liquidity in the system, and even small scale improvements that we are able to make in terms of driving basis point improvements in the performance of ads or single digit increases in conversions relative to impressions in a given quarter off of a large base mean that we're really able to continue to grow the absolute dollars of revenue growth in a pretty meaningful way.
Your next question comes from the line of Justin Post with Bank of America. Please go ahead.
Actually,
thank you.
Hey, Justin, just give us 1 second. I think there was a second Mark's question that we just want to get to on MSL.
Yeah, I mean, I'll keep it quick. I mean, I don't think we have any specific timing to announce certainly on the models or products, but I expect that you will see both. We expect to build novel models and novel products, and I'm excited to share more when we have it.
Krista,
Justin, please go ahead.
Great, thanks. Mark, you mentioned the prior two content cycles, and obviously you've been able to generate very attractive margins on them. As we get into the AI cycle, obviously some concerns on the investment, but can you talk a little bit about how you're thinking about tools that could be coming out for users? I know there's some new competition. And then secondly, how you think about margins in this content cycle? Any reason to think they would be different versus prior cycles? Thank you.
I think it's too early to really understand what the margins are going to be for the new products that we build. I mean, I think certainly each product has somewhat different characteristics, and I think we'll kind of understand how that goes over time. I mean, my general goal is to build a business that maximizes value for the people who use our products and maximizes profitability, not margin. So I think we'll kind of just try to build the best things that we can and try to deliver the most value that we can for most people. I don't know.
Your next question comes from the line of Ross Sandler with Barclays. Please go ahead.
Great. Hey, Mark, some of the goals for competing AI labs are around achieving AGI or these other milestones that are kind of like out there and a little esoteric. How are you setting up your new team in terms of achieving those types of goals versus products that can generate revenue for Meta kind of right out of the gate? And is the goal that you had articulated to us previously around giving, billions of people kind of a personal AI to use, still the direction of travel that you see, or is there, other things like kind of this Vibes or Sora angle that you think are potentially important? How should we think about like the overall direction? Thank you.
Sure. So the way that I think about this is that the research is going to enable new technological capabilities to exist. And then those capabilities can get built into all kinds of different products. So the ability to reason more intelligently is, for example, very important across a large number of things. It would be useful for an assistant. It will also be useful in business AI. It will also be useful in the AI agent that we're building to help advertisers figure out what their campaigns are going to be. It will also have implications for eventually how we do ranking and recommendations of people's feeds and make different decisions there. That's just one example. I mean, certainly the capability to be able to produce very high quality, good video is going to be useful for giving people new creative tools. It will help increase the amount of content inventory that can be shown in Instagram and Facebook, and therefore should enable an increase in engagement there. It should help advertisers be able to create creative that will help us monetize better. So you can just go kind of down the list of capabilities that you'd expect. And I think each one will enable a bunch of different things. And I think the art of product development here is looking at the list of technology capabilities and figuring out what new products are going to be useful and prioritizing those. But fundamentally, I would sort of expect this exponential curve in new technology capabilities that are going to become available. And the other thing that I expect is that I think being the best in a given area will drive great returns rather than, this is not like a check the box exercise of like, okay, we can generate some kind of content and someone else can. I think that like the company that is the best at each of these capabilities, I think will get a large amount of the potential value for doing that. So there are lots of different capabilities to build. I'm not sure that any one company is going to be the best at all of them. I doubt that's going to be the case. But a lot of what we're trying to do is not kind of do some things that others have done. We're really trying to build novel capabilities. And I'm keeping this high level because I don't want to necessarily from a competitive or strategic perspective get into what we're prioritizing. But that hopefully gives you a sense of how we're thinking about what we're doing. We want to be able to kind of build novel things, build them into a lot of our products, and then have the compute to scale them to billions of people. And we think that that's going to both show up in terms of new products being possible and new businesses and very significant improvements to the current business too.
Your next question comes from the line of Mark Mahaney with Evercore ISI. Please go ahead.
Thanks. Can I just ask just a question on Meta AI and both product and a monetization path? So when you look at it, what you've seen that's most encouraging to you in terms of the adoption and the use of Meta AI, and then when you think about, I know you generally like to roll out and then deepen engagement and then later think about monetization. Like, where do you think you are on that path now? Is it clear to you what the monetization options are for Meta AI? Thank you very much.
I mean, I think the most promising thing that we're seeing is one, that we were able to build something that a large number of people use. And I think that that's valuable. And then secondly, that there is a clear correlation as we improve the models in ways that we think make them better, that people use them more. So that shows that we have a runway to basically be able to improve engagement and turn this into a product that's leading over time. In terms of where we are on this, and we basically just did this huge effort to boot up Meta Superintelligence Labs and build what I am very proud of is, I think, the highest talent density lab in the industry at this point. There are a lot of really great researchers and infrastructure folks and data folks who are now a part of this effort, who are focused on training the next generation of work and doing some really novel work. And when that is ready, I think that we will be able to plug that into a number of the products that we're building, and I think that will be very exciting. But I think that that's really the next thing that we're looking at. And then from there, I think that these models will also improve monetization in all of the different ways that we've talked about so far, in terms of improving engagement, improving advertising, helping advertisers engage. I mean, there's the one opportunity that we usually talk about on these calls, but hasn't come up as much here, is just the ability to make it so that advertisers are increasingly just going to be able to give us a business objective and give us a credit card or bank account, and like have the AI system basically figure out everything else that's necessary, including generating video or different types of creative that might resonate with different people, that are personalized in different ways, finding who the right customers are. All of these, all of the capabilities that we're building, I think, go towards improving all of these different things. So I'm quite optimistic about that.
Your next question comes from the line of Ronald Josie with Citi. Please go ahead.
Great, thanks for taking the question. And this maybe dovetails perfectly off, Mark, what you just talked about. And, you know, we heard a lot about end-to-end automation here, I think reaching a $60 billion ARR. I wanted to hear about, if you can talk to us more just about adoption rates amongst the advertisers, and then maybe bigger picture, as you incorporate ranking recommendation changes like Andromeda or GEMS or Lattice, just talk to us how this automation is driving, call it a higher ROI for advertisers overall as we bring it all together. Thank you.
Yeah, so we've been sort of laying the continued brick by brick build of Advantage Plus and extending the set of objectives that it applies to over time. And so in Q3, we completed the global rollout of the streamlined campaign creation flow for Advantage Plus lead campaigns. So now advertisers who are running sales app or lead campaigns have end-to-end automation turned on from the beginning. And like, you know, the kind of application of the streamlined campaign creation flow for other objectives, this generally allows advertisers to optimize and automate several aspects of the campaign setup process at once. That includes things like audience selection, where to show the ad, how the budget gets paced and distributed across ad sets to drive the most efficient outcomes. And, you know, we see that Advantage Plus continues to drive performance gains. Advertisers who run lead campaigns using Advantage Plus are seeing a 14% lower cost per lead on average than those who are not. And I would say that we think that there is still a lot of opportunity generally to grow adoption of Advantage Plus. A lot of advertisers only use our end-to-end automated solutions for a portion of their campaigns, so we can grow share there. And to capture that opportunity, we're focused on driving continued performance improvements and addressing some of the key use cases that we still need in order to grow adoption. We're also working to broaden adoption among advertisers who use one of our single-step automated solutions. For example, advertisers who might only use a piece of it, like Advantage Plus Audiences, by helping them understand the benefits of using more than one automated solution at the same time. So I would say Advantage Plus is sort of an ongoing platform by which we both continue to expand the feature set that is available in Advantage Plus, and then expand the extensibility or the coverage of that feature set to sort of the broader set of advertisers. You know, I think Mark mentioned that the annual revenue run right now for advertisers who are using these automated options is, $60 billion. And again, we see that there's room to continue growing that.
Your next question comes from the line of Youssef Squali with Truist Securities. Please go ahead.
Great. Thank you very much. Mark, on wearables in particular, do you think you'll be able to sell enough hardware to recoup your investment, or is that dependent on maybe creating new avenues for revenue from things like advertising services and commerce through that new computing platform? And if so, what are kind of the gating factors there? And then Susan, how do you see the on-balance sheet versus off-balance sheet financing of your AI initiatives? You've recently struck a deal with Blue Owl for the Louisiana data center. Is that part of the CapEx guide for 26? And if it's not, how significant will that way of funding be for Meta going forward? And basically, would that slow down your CapEx growth past 2026? Thank you.
I can talk about wearables, and then Susan can jump in on the other part. So I think that there are a few pieces here. One is that the work that on Ray-Ban Meta and the Oakley Meta products is going very well. I think, yeah, I mean, at some point, if these continue going as well as it has been, then I think it will be a very profitable investment. I think that there's some revenue that we get from basically selling the devices, and then some that will come from additional services and from the AI on top of it. So I think that there's a big opportunity. Certainly, the investment here is not just to kind of build just the device. It's also to build these services on top. Right now, a lot of people get the devices for a range of things that don't even include the AI, even though they like the AI. But I think over time, the AI is going to become the main thing that people are using them for. And I think that that's going to end up having a big business opportunity by itself. But as products like the Ray-Ban Meta and Oakley Metas are growing, we're also going to keep on investing in things like the more full field of view product form of the Orion prototype that we showed at Connect last year. So those things are obviously earlier in their curve towards getting to being a sustaining business. And our general view is that we want to build these out to reach many hundreds of millions or billions of people. And that's the point at which we think that this is going to be just an extremely profitable business.
Youssef, to your second question, so the JV that we announced with Blue Owl is sort of an example of finding a solution that.
All right, guys, we're going to cut the Meta earnings call there. I appreciate that some of you guys might be extremely interested in that, but I do want to hop over to the Google call. Why the heck is this not letting me exit? There we go. But yeah, so I want to hop over to the Meta call, or sorry, the Google call. So we will get prepared to get over to that. All right, everybody can hear the music, yeah? Thumbs up, thumbs down. But yeah, interesting call with Meta. I honestly think, in the background, I bought a share of Meta. It's one of those companies that you can see the stuff I watch, like Neurompure and everything like that. You got a Meta over there with 7,500. Congrats to him. Great earnings stream. But yeah, I muted it, by the way. So yes. So hopefully you're still not hearing it, but I muted it for the time being. But the hope is once this actually starts, I'll unmute it. But I think Meta had a really good call. I do think that one-time tax item, it's just that. It's a one-time thing. And I'm kind of curious, though. I mean, the thing that I'm going to be watching with Meta, which obviously is going to take time, is obviously that operating expenditure piece, right? Operating margins drop from 42% to 40%. And that's not inclusive of anything associated with the taxes, right? That's completely disparate. And so that's one thing that I'm kind of looking at is, okay, you're hiring a bunch of people, you're adding all this hardware piece. Very curious to see what happens. All right, Google call starting now.
2025 earnings conference call. At this time, all participants are in a listen-only mode. After the speaker presentation, there will be a question and answer session. To ask a question during the session, you will need to press star 1 on your telephone. I would now like to hand the conference over to your speaker today, Jim Friedland, Head of Investor Relations. Please go ahead.
Conference call. With us today are Sundar Pichai, Philip Schindler, and Anat Ashkenazi. Now, I'll quickly cover the safe harbor. Some of the statements that we make today regarding our business, operations, and financial performance may be considered forward-looking. Such statements are based on current expectations and assumptions that are subject to a number of risks and uncertainties. Actual results could differ materially. Please refer to our Forms 10-K and 10-Q, including the risk factors. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and non-GAAP financial measures. A reconciliation of non-GAAP to GAAP measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at abc.xyz/investor. Our comments will be on year-over-year comparisons unless we state otherwise. And now, I'll turn the call over to Sundar.
Thank you, Jim. Good afternoon, everyone, and thanks for joining us. This was a terrific quarter for Alphabet, driven by double-digit growth across every major part of our business. We are seeing AI now driving real business results across the company. We delivered our first ever $100 billion quarter. 5 years ago, our quarterly revenue was at $50 billion. Our revenue number has doubled since then, and we are firmly in the generative AI era. In parallel, we've built for the long term and diversified with successful businesses in cloud, YouTube, and subscriptions. Our momentum is strong, and we are shipping at speed. As just a few examples, our first-party models like Gemini now process 7 billion tokens per minute via direct API use by our customers. The Gemini app now has over 650 million monthly active users, and queries increased by 3x from Q2. Cloud had another great quarter of accelerating growth with AI revenue as a key driver. Cloud backlog grew 46% quarter over quarter to $155 billion. And we crossed 300 million paid subscriptions, led by growth in Google One and YouTube Premium. Today, I'll discuss progress in our full-stack approach to AI and then share highlights from Search, Cloud, YouTube, and Waymo. As a reminder, our full-stack approach spans AI infrastructure, world-class research, including models and tooling, and our products and platforms that bring AI to people everywhere. First up, AI infrastructure. Our extensive and reliable infrastructure, which powers all of Google's products, is the foundation of our stack and a key differentiator. We are scaling the most advanced chips in our data centers, including GPUs from our partner NVIDIA, as well as our own purpose-built TPUs. And we are the only company providing a wide range of both. As we announced yesterday at NVIDIA GTC, we are now shipping the new A4X Max instances powered by NVIDIA GB300 to our cloud customers. Our highly sought-after TPU portfolio is led by our 7th generation TPU Ironwood, which will be generally available soon. We are investing in TPU capacity to meet the tremendous demand we are seeing from customers and partners, and we are excited that Anthropic recently shared plans to access up to 1 million TPUs. Next, world-class AI research, including models and tooling. Our models are world-leading. Gemini 2.5 Pro, Veo, Genie 3, and our viral sensation Nano Banana are among the very best in class. Over 230 million videos have been generated with Veo 3. And more than 13 million developers have built with our generative models. We are looking forward to the release of Gemini 3 later this year. Our research leadership is advancing next frontier technologies. Last week, we announced that our Willow quantum chip achieved a major breakthrough, running an algorithm 13,000 times faster than one of the world's best supercomputers. And the result is verifiable, paving the way to future practical applications. Speaking of quantum, let me congratulate Michel Devray, our chief scientist for quantum hardware. He received a Nobel in physics for early research he did in the 1980s. 3 Nobels awarded to current Googlers in 2 years. Incredible. And third, our products and platforms. We are bringing AI to more people and developers than anyone else. In July, we announced that we processed 980 trillion monthly tokens across all our surfaces. We are now processing over 1.3 quadrillion monthly tokens, more than 20x growth in a year. Phenomenal. This quarter, we took big steps to reimagine Chrome as a browser powered by AI through deep integrations with Gemini and AI mode in search, with more agentic capabilities coming soon. In August, at Made by Google, we unveiled our Pixel 10 series of devices. They are the first with our most powerful chip designed to run on Gemini Tensor G5. They are our best reviewed devices ever. And last week, we launched Android XR, our new operating system with Samsung's Galaxy XR device. It brings new ways to use headsets and glasses with Gemini at the core. Now turning to highlights from search. AI is driving an expansionary moment for search. As people learn what they can do with our new AI experiences, they're increasingly coming back to search more. Search and its AI experiences are built to highlight the web, sending billions of clicks to sites every day. During the Q2 call, we shared that overall queries and commercial queries continued to grow year over year. This growth rate increased in Q3, largely driven by our AI investments in search, most notably AI overviews and AI mode. Let me dive into the momentum we are seeing. As we have shared before, AI overviews drive meaningful query growth. This effect was even stronger in Q3 as users continue to learn that Google can answer more of their questions. And it's particularly encouraging to see the effect was more pronounced with younger people. We're also seeing that AI mode is resonating well with users. In the US, we have seen strong and consistent week-over-week growth in usage since launch, and queries doubled over the quarter. Over the last quarter, we rolled out AI mode globally across 40 languages in record time. It now has over 75 million daily active users. And we shipped over 100 improvements to the product in Q3, an incredibly fast pace. Most importantly, AI mode is already driving incremental total query growth for search. Philip will talk more about monetization and share how AI is helping people connect with businesses and shop on search. Next, Google Cloud. Our complete enterprise AI product portfolio is accelerating growth in revenue, operating margins, and backlog. In Q3, customer demand strengthened in 3 ways. 1, we are signing new customers faster. The number of new GCP customers increased by nearly 34% year over year. 2, we are signing larger deals. We have signed more deals over $1 billion through Q3 this year than we did in the previous 2 years combined. Third, we are deepening our relationships. Over 70% of existing Google Cloud customers use our AI products, including Banco BV, Best Buy, and FairPrice Group. As we scale, we are diversifying revenue. Today, 13 product lines are each at an annual run rate over $1 billion. And we are improving operating margin with highly differentiated products built with our own technology. This deep product differentiation starts with our AI infrastructure. We have a decade of experience building AI accelerators and today offer the widest array of chips. This leadership is winning customers like HCA Healthcare, LG AI Research, and Macquarie Bank. And it's why 9 of the top 10 AI labs choose Google Cloud. We are also the only cloud provider offering our own leading generative AI models, including Gemini, Imagen, Veo, Chirp, and Lyria. Adoption is rapidly accelerating. In Q3, revenue from products built on our generative AI models grew more than 200% year over year. Over the past 12 months, nearly 150 Google Cloud customers each processed approximately 1 trillion tokens with our models for a wide range of applications. For example, WPP is creating campaigns with up to 70% efficiency gains. Swarovski has increased email open rates by 17% and accelerated campaign localization by 10 times. Earlier this month, we launched Gemini Enterprise, the new front door for AI in the workplace, and we are seeing strong adoption for agents built on this platform. Our packaged enterprise agents in Gemini Enterprise are optimized for a variety of domains, are highly differentiated, and offer significant out-of-box value to customers. We have already crossed 2 million subscribers across 700 companies. Next, YouTube. In the living room, YouTube has remained #1 in streaming watch time in the US for more than 2 years, according to Nielsen. Last month marked YouTube's first time as a live NFL broadcaster. This exclusive global broadcast, live from Brazil, drew more than 19 million fans and set a new record for most concurrent viewers of a live stream on YouTube. YouTube Shorts also continues to perform well. In the US, Shorts now earn more revenue per watch hour than traditional in-stream on YouTube. At our Made on YouTube event, we rolled out a number of AI-powered features that are helping creators supercharge creation and build their businesses. AI is now streamlining the entire content creation workflow, from generative video tools and more efficient editing to AI-powered insights that help creators optimize their channels. We are also using AI to expand monetization, automatically And finally, Waymo. Next year, Waymo aims to open service in London, and they are working to bring service to Tokyo. They've also announced expansions to Dallas, Nashville, Denver, and Seattle, and secured permission to operate fully autonomously at San Jose and San Francisco airports. Autonomous testing continues to scale in New York City. The new Waymo for Business allows enterprises to offer Waymo as a work travel option. And we launched Waymo Teens accounts in Phoenix this summer. We are pleased to see usage steadily increase with positive feedback from teens and their parents alike. Waymo's growth and momentum are strong, and 2026 is shaping up to be an exciting year. Overall, a milestone quarter. The incredible work of our teams is driving momentum across the board, and our leadership in AI positions us so well for the opportunity ahead. I want to thank all of our partners and our employees for their hard work and an excellent Q3. With that, I'll turn it over to Philip.
Thanks, Sundar, and hello, everyone. I'll quickly cover performance for Google Services for the quarter, then structure the rest of my remarks around the great progress we're delivering across search, ads, YouTube, and partnerships. Google Services revenues were $87 billion for the quarter, up 14% year-on-year, driven by accelerated growth in search and YouTube, partially offset by year-on-year decline in network revenues. Adding some further color to our results, the 15% increase in search and other was led by growth across all major verticals, with the largest contributions from retail and financial services. YouTube saw similar performance across verticals. Its 15% growth in advertising revenues was driven by direct response, followed by brand. Starting with search and other revenues, which delivered over $56 billion in revenue for the quarter. As Sundar mentioned, AI is driving an expansionary moment and transforming how people use Google Search. Our investments in new AI experiences, such as AI overviews and AI mode, continue to drive growth in overall queries, including commercial queries, creating more opportunities for monetization. These AI experiences are enhancing how people connect with businesses and shop on search. We recently added shopping capabilities in AI mode, which now help people shop conversationally in search, and we expanded try-on capabilities to more clothing items, now available to anyone in the US. Lastly, we're making it easier for consumers to benefit from deals through new loyalty offerings like personalized annotations on organic results and ads. Looking at monetization, businesses can now tap into our most powerful AI search experiences. Using our most advanced AI models, we can understand and predict intent like never before, unlocking entirely new commercial pathways to provide valuable new consumer connections and helping us monetize even more efficiently. Rolled out globally in September, AI Max and Search is already used by hundreds of thousands of advertisers, currently making it the fastest growing AI-powered search ads product. In Q3 alone, AI Max unlocked billions of net new queries. By delivering the most relevant ad across surfaces and matching advertisers against additional queries they weren't reaching before, AI Max helps advertisers discover new customers at the exact moment they need their product or service. Kayak, for example, looked to grow conversions while staying within their ROAS goals. After turning on AI Max and Search, they grew the conversion value by 12% in early tests. We continue to infuse generative AI capabilities at every step of the marketing process. We rolled out Imagen 4 in Asset Studio and Product Studio, helping businesses produce more and better creatives. On the measurement front, we enriched the model supporting Meridian, our marketing mix model, with additional variables. And more granular reporting in PMax is making bidding more effective. Financial services company SoFi has been using PMax to meet its ambitious growth targets and help drive a 39% improvement in its conversion volume year over year. Moving to YouTube, where we saw accelerated revenue growth, our recommendation systems are driving robust watch time growth in our key monetization areas like Shorts and Living Room. As we leverage Gemini models, we're seeing further discovery improvement. On direct response, we're excited about the growth in revenue we're seeing, especially from small and medium advertisers adopting Demand Gen. We also improved performance on Demand Gen, with over 100 launches helping to increase conversion value by more than 40% for advertisers using target-based bidding on YouTube. The retail vertical continues to lead our growth on YouTube, with Demand Gen helping us further monetize shopping-related categories. Looking at the living room, our long-term bet more advertisers are adopting interactive direct response ads, leading to an annual revenue run rate exceeding $1 billion globally for this format. For our viewers, we continue to give fans greater access across sports while tapping into the best of YouTube's product innovation and creator-led content. Sundar mentioned that we expanded our NFL partnership with our first ever exclusive global broadcast of an NFL game. Brands loved the opportunity, and we sold all our ad inventory within a couple of weeks. Looking at creators, a significant force behind the thriving YouTube creator economy is the collaboration between creators and brands. Tools like direct linking to deals, websites, and Shorts, and swappable brand segments in long form will soon help creators show how they deliver great value for brands. Thanks to a collaboration with Dude Perfect, Comcast Xfinity drove an 8% search lift, beating other Xfinity ads' recall lift on Shorts by 34%. At the same time, it decreased the cost per lifted user by 50% when compared to the next most efficient ad. We continue to invest in AI-powered features that are helping creators supercharge creation and build their businesses. With VO3 integration and speech-to-song, creators go from idea to iteration quicker, and new channel insights help them better understand performance. Ending on YouTube with our subscriptions products, we're also seeing momentum with strong growth in offerings such as YouTube Music and Premium and YouTube TV. We're also applying Gemini internally to help us serve customers with increased speed, intelligence, and efficiency. Our sales teams use Gemini enriched with ads knowledge to streamline customer interactions. This increased productivity by over 10%, led to hundreds of millions in incremental revenue, and frees up sellers to engage with more customers at a deeper, more strategic level. In our customer support division, Gemini-powered solutions have managed over 40 million customer sessions so far this year and resolved hundreds of thousands of customer inquiries, and we're just getting started. As always, I'll wrap with the progress we're seeing across partnerships where our customers tap into the strength and breadth of Google's products to accelerate their transformation. Revolut, the global financial services company, leverages Google Cloud's Vertex AI platform and Gemini models to help power its advanced customer service chatbot, develop new hyper-personalized financial products, and offer predictive insights. Revolut is also increasing its presence on YouTube, adopting VO3 for personalized creatives, making Google a key ads partner for delivering growth and launching new markets. In closing, I'd like to thank Googlers everywhere for their contributions to our success, and as always, to our customers and partners for their continued trust. And, of course, a huge thanks to all of you as we celebrate 25 years of Google Ads. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the third quarter, unless I state otherwise. I will start with results at the Alphabet level and will then cover our segment results. I'll end with some commentary on our outlook for the fourth quarter of 2025. We had an outstanding quarter in Q3, continuing the strong momentum we've had throughout the year, delivering double-digit revenue growth across search and YouTube advertising, subscriptions, platforms and devices, and Google Cloud. consolidated revenue reached $102.3 billion, a 16% year-over-year increase, or 15% in constant currency. Total cost of revenue was $41.4 billion, up 13%. Tech was $14.9 billion, up 8%. Other cost of revenues was $26.5 billion, up 16%, with the increase primarily driven by content acquisition cost, largely for YouTube, followed by depreciation and other technical infrastructure operations cost. Total operating expenses increased 28% to $29.7 billion. R&D expenses increased by 22%, driven by compensation and depreciation expenses related to our AI efforts. Sales and marketing expenses were flat, and G&A expenses increased meaningfully, primarily due to the $3.5 billion charge related to the European Commission fine mentioned in the earnings press release. Operating income increased 9% this quarter to $31.2 billion, and operating margin was 30.5%. Excluding the EC fine, operating income increased 22%, and operating margin was 33.9%. Operating margin benefited from strong revenue growth and continued efficiencies in our expense base, offset by the legal charge and a significant increase in depreciation expense. Other income and expenses was $12.8 billion, primarily due to unrealized gains in our non-marketable equity securities portfolio. Net income increased 33% to $35 billion, and earnings per share increased 35% to $2.87. We generated free cash flow of $24.5 billion in the third quarter and $73.6 billion for the trailing 12 months. Free cash flow in Q3 benefited from strong operating cash flow and recent tax changes regarding the timing of when research and development costs are expensed and assets are depreciated. This was partially offset by higher CapEx. We ended the quarter with $98.5 billion in cash and marketable securities. Turning to segment results, Google Services revenues increased 14% to $87.1 billion, reflecting strength in Google Search, YouTube advertising, and subscriptions. Google Search and other advertising revenues increased by 15% to $56.6 billion, representing another robust quarter with continued growth across all major verticals, with the largest contributions from retail and financial services. YouTube advertising revenues increased 15% to $10.3 billion, driven by direct response advertising, followed by brand. Network advertising revenues of $7.4 billion were down 3%. Subscriptions, platforms, and devices revenues increased 21% this quarter to $12.9 billion, driven by very strong growth in both YouTube and Google One subscriptions. Google Services operating income increased 9% to $33.5, were offset by the impact of the EC fine, which was fully reflected in the Google Services segment. Turning to the Google Cloud segment, which again delivered very strong results this quarter as Cloud continued to benefit from our enterprise AI-optimized stack, including our own custom TPUs and our industry-leading AI models. Cloud revenue increased by 34% to $15.2 billion in the third quarter, driven by strong performance in GCP, which continued to grow at a rate that was much higher than Cloud's overall revenue growth rate. GCP's growth was driven by enterprise AI products, which are generating billions in quarterly revenue. We had strong growth in enterprise AI infrastructure and enterprise AI solutions, which benefited from demand for our industry-leading models, including Gemini 2.5. Core GCP was also a meaningful contributor to growth. And we had double-digit growth in Workspace, which was driven by an increase in average revenues per seat and the number of seats. Cloud operating income increased by 85% to $3.6 billion, and operating margin increased from 17.1% in the third quarter last year to 23.7% this quarter. The expansion in Cloud operating margin was driven by strong revenue performance and continued efficiencies in our expense base, partially offset by higher technical infrastructure usage cost, which includes depreciation expense and other operations costs such as energy. Google Cloud's backlog increased 46% sequentially and 82% year over year, reaching $155 billion at the end of the third quarter. The increase was driven primarily by strong demand for enterprise AI. As Sundar mentioned earlier, Cloud has signed more billion-dollar deals in the first 9 months of 2025 than in the past 2 years combined. In other bets, revenues were $344 million, and operating loss was $1.4 billion in the third quarter. Within other bets, we continue to allocate more resources to businesses like Waymo, where we see opportunities to create substantial value. With respect to CapEx, in the third quarter, our CapEx was $24 billion. The vast majority of our CapEx was invested in technical infrastructure, with approximately 60% of that investment in servers and 40% in data centers and networking equipment. In Q3, we returned capital to shareholders through repurchases of stock of $11.5 billion and dividend payments of $2.5 billion. Turning to our outlook, I would like to provide some commentary on factors that will impact our business performance in the fourth quarter of 2025, as well as an updated outlook for CapEx for the year. First, in terms of revenues, we're pleased with the overall momentum of our business. At the current spot rates, we could see an FX tailwind to our revenues in Q4. However, the volatility in exchange rates could affect the impact of FX on Q4 revenues. As for our segments, in Google Services, year-over-year comparisons in advertising will be negatively impacted by the strong spend on U.S. elections in the fourth quarter of 2024, particularly on YouTube. In Cloud, demand for our products remains high, as evidenced by the accelerating revenue growth and the $49 billion sequential increase in Cloud backlog in Q3. In GCP, we see strong demand for enterprise AI infrastructure, including TPUs and GPUs, enterprise AI solutions driven by demand for Gemini 2.5 and our other AI models, and core GCP infrastructure and other services, such as cybersecurity and data analytics. As I've mentioned on previous earnings calls, while we have been working hard to increase capacity and have improved the pace of server deployments and data center construction, we still expect to remain in a tight demand-supply environment in Q4 and 2026. Moving to investments, we're continuing to invest aggressively due to the demand we're experiencing from Cloud customers, as well as the growth opportunities we see across the company. We now expect CapEx to be in the range of $91 billion to $93 billion in 2025, up from our previous estimate of $85 billion. Keeping in mind that the timing of cash payments can cause variability in the reported CapEx number. Looking out to 2026, we expect a significant increase in CapEx, and we'll provide more detail on our fourth quarter earnings call. In terms of expenses, first, as I've mentioned on previous earnings calls, the significant increase in our investments in technical infrastructure will continue to put pressure on the P&L in the form of higher depreciation expenses and related data center operations costs, such as energy. In the third quarter, depreciation increased $1.6 billion year over year to $5.6 billion, reflecting a growth rate of 41%. Given the overall increase in CapEx investments, we expect the growth rate in depreciation to accelerate slightly in Q4. Second, we expect sales and marketing expenses to be more heavily weighted to the end of the year, in part to support product launches and the holiday season. Q3 was a strong quarter, and we're excited with the adoption of our AI products, helped by a rapid pace of innovation and great execution by our teams. This translated into strong momentum in search, YouTube ads, subscription platforms and devices, and Cloud, resulting in our first $100 billion plus quarter. Now, Sundar, Philip, and I will now take your questions.
Thank you. As a reminder, to ask a question, you will need to press star one on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. Our first question comes from Brian Nowak with Morgan Stanley. Your line is now open.
Great. Thanks for taking my questions, everyone. The first one, maybe for for Philip or Sundar. It's on agentic e-commerce and agentic travel. There's a lot of external Wall Street discussion about agentic e-commerce potentially monetizing at a lower rate than search. So the question is, what factors are you most focused on to sort of ensure a smooth transition for your search business and for your advertisers as you move over to a more agentic world? And the second one, Sundar, is on Waymo. How far are we from an integration of Waymo into more of the core Gemini capabilities and the users on the platform? You're taking your user data of where I'm going, what hotel I'm staying at, what airport I'm staying at, and have me integrate that into Waymo, so you can actually have users use their profiles to pre-schedule Waymos. How far off is that? What do we have to do?
Look, Brian, great question. This is all early, but we see agentic experiences really as additive to the way people seek information. It helps us answer people's tough questions. It helps people get stuff done, and it helps businesses in the process. And we're working on multiple agentic experiences across key verticals such as travel, commerce, shopping, and so on. And we're paying a lot of attention to creating a seamless user experience, but also to the fact that we need to integrate different partner ecosystems in a way that it creates value for them. And by the way, we're also working closely with a lot of our partners on the other side through our cloud services to improve their own agentic experiences. And so maybe we go a little deeper on the shopping side, where we actually use AI already very actively to improve the shopping experience. As you know, we launched a more visual experience on AI Mode that gives people a much more intuitive conversational way to shop. You can simply describe what you're looking for now, like the way you would talk to a friend, and we'll show you the visual shopping results. And then we think about building an agentic shopping future, and it has to be one, again, that benefits both users and merchants here. And you know that AIO, we also introduced new agentic checkout, which will let shoppers use like agentic AI to buy products from merchant sites and so on. We have a partnership with PayPal to help merchants build agentic commerce experiences. We have a new open protocols for agent-to-agent transactions, and so on and so on.
And Brian, on Waymo, great question. I was reflecting, I think, on the exact same topic. I'm scheduled to meet with the team to do a review on it in a few weeks out. Look, it is an exciting time. Waymo clearly, is scaling up, particularly in 2026. And I think the possibility, as you said, of Gemini, particularly with the multimodal experience, as well as services like YouTube, I think there's a real opportunity to make the in-car experience dramatically better. Definitely something we are excited about, and you'll see newer experiences in 2026 for sure.
Great, thank you both.
Our next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking the questions. Philip, maybe you can just talk more about some of the drivers of the core search strength. And I guess in particular, when you think about AI overviews and AI mode, we know that query growth is accelerating, but can you help us understand from there kind of what happens in terms of clicks per query and conversion rates and pricing in these AI-driven search formats? And then, Anat, can you talk about where you see opportunities in the core cost base as you look to make room to absorb the rapid growth in infrastructure and depreciation going forward? Thanks.
So let me give you a bit of vertical color first. In Q3, search and other revenues again delivered growth across all major verticals. As we said, it was from retail and financial services. Healthcare was also a contributor to the growth here. Our new AI experiences, you mentioned them, AI overviews, AI mode, continue to drive growth in overall queries, including commercial queries, really creating more opportunities for monetization. AI overviews are scaling up and are working for our entire user base. We're now scaled to over 2 billion users here, and we're continuing to expand ads in AI overviews in English to more countries across desktop, mobile, and so on. And as I've shared before, for AI overviews, even at our current baseline of ads, below and within the AI's response, overall, we see the monetization at approximately the same rate. So over time, we're excited about the opportunity of richer experiences in AI mode and AI overviews to basically open up then the opportunity for also much richer placements. I think, as I've said on a prior call, we managed the business to drive great outcomes for our users and an attractive ROI for our advertisers. We don't really manage to paid clicks and CPC targets, but as you will see in the 10Q, paid clicks were up 7% year on year, and CPCs were up 7% year on year.
Doug, and to your question around where else can we see more opportunity for efficiency and productivity, and I think you heard me say before, this is not a one-time type of effort, but rather an ongoing way in which we manage the business. And the key here is that the more we drive productivity across our business, the more we can invest in the business for growth and obviously continue to drive improvement in the P&L. Some of the areas are things that you've heard us talk about in the past, such as moderating the pace of headcount growth, optimizing our real estate footprint, but also as we invest more and more in our technical infrastructure, ensuring that we are optimizing that build out and the overall technical infrastructure we have. You know that a lot of the data centers, for example, that we build ourselves, so they're optimized and we make sure we do them in the most efficient way. Sundar mentioned on one of the previous calls the productivity associated with leveraging AI for Google. So there's the example, the percent of code, now nearly half of all code generated by AI. That's a way for us to leverage AI to drive further productivity across the business. And obviously, we always look at making sure that when we provide services or products, that we get the right economics and the right value for what we provide. So the one good example is Shorts, which has a lower revenue share than InStream. That it helps to improve some of our gross margins. So this is an effort we have ongoing. I've mentioned in the past that we have a headwind with depreciation, obviously increasing alongside our CapEx increase. So we have efforts across the organization to ensure we run the business in the most disciplined and productive way while continuing to invest for future growth.
Thank you both.
Our next question comes from Eric Sheridan with Goldman Sachs. Your line is now open.
Thank you so much for taking the questions. Maybe two, if I could. Sundar, when you think about your custom silicon efforts across the organization, can you reflect a little bit about the opportunity set you see with each passing generation of custom silicon, both in terms of driving operating efficiencies inside the organization and potentially increased monetization efforts around those outside of the organization? Second question would be for Philip. Obviously, we can see the YouTube advertising revenue number in the reported results. Can you reflect a little bit about the scaling of the subscription side of YouTube offerings and how the two parts in together maybe represent an interesting framework in thinking about the monetization side of YouTube increasingly being a mix of both ads and subscription? Thank you.
Eric, overall, I would say we are seeing substantial demand for our AI infrastructure products, including TPU-based and GPU-based solutions. It is one of the key drivers of our growth over the past year, and I think on a going forward basis, I think we continue to see very strong demand, and we are investing to meet that. I do think a big part of what differentiates Google Cloud, effectively, we've taken a deep full stack approach to AI. So we are, and that really plays out, right? We are the only hyperscaler who's really building offerings on our own models. And we are also highly differentiated on our own technology. So to your question, I think that does, give us the opportunity to continue driving growth and operating margins in cloud as we have done in the past, and also I think from a revenue, sets the infrastructure portion of our business to be a growth driver looking ahead as well.
And to the second part of your question, look, just taking a quick step back, we often describe YouTube's business as a flywheel. Obviously, it first all starts with the creators, and we have significantly invested here to be the place that YouTube creators really call their home. That's a big piece of it, the number one piece. Viewers, of course, YouTube has billions of monthly logged in users, and every day people watch billions of hours of video. And we talked about how our recommendation systems are driving robust watch time growth, and so on and so on. So on the monetization side, YouTube's business is really powered, I would say, let's call it a twin engine monetization strategy, combining its advertising business and its growing subscription services. Both YouTube ads and subscriptions saw strong growth this quarter. And so looking at YouTube Music and Premium, users are on average delivering more value to creators, to music, media partners, and YouTube itself than even ad-supported users do. So in other words, on average, a YouTube Music and Premium subscriber generates a meaningful higher gross profit than they were simply an ad-supported users. And fans come from all over the world, you know this, and this engagement through ads and subscription generates YouTube's revenues and funds what I started with, these creators here. And this then drives more viewership and engagement and so on. And that's the flywheel. And so our priority continues like this growth cycle. We're happy with this twin engine monetization strategy.
Our next question comes from Mark Shmulik with Bernstein. Your line is now open.
Yes, thanks for taking the questions. Sundar, with the strong adoption of Gemini, AI mode, and overviews across the user base, are there any meaningful differences to call out kind of around the behavior and depth of engagement for those users across the entire Google ecosystem? And then, Philip, I know we kind of asked this, most quarters, but I'm curious kind of with some of the adoption you've seen around AI overviews and mode, how you see the economics of search evolving with the higher commercial and total query volume and how it kind of compares against the incremental cost to deliver these results. Thank you.
Mark, look, I think obviously AI overviews are a natural part of the Google experience. And so, engagement is very, very high. I would say AI mode, you have a varied cohorts. There are people who are casual users who are checking it out, but there's a core group which really likes AI mode and is passionate about it. And so you see the early adopters, the product is resonating very strongly and they are seeking it out. So I think that's how I would highlight the difference. With Gemini, again, set of engaged user base who are seeking out the product and so on. But across the board, I think the trajectory has been we are definitely seeing in each of those use cases a set of early adopters, and then more people coming in, and the people who are using it continue to use it more over time and report high user satisfaction. So I would say the underlying product metrics are pretty encouraging to see as well.
Look into the second part of your question. I think we covered before, Sundar covered the query development. And as I've just said before, for the AI overviews, even at our current baseline of ads, right, whether above, below, and within the AI response, overall, we see the monetization at approximately the same rate. And this is a great baseline for further innovation. We talked about this. We're excited about where this can go. And on the AI mode side, we're testing ads in AI mode, and we'll continue to test and learn before we expand this any further. So this in combination with what we mentioned about the commercial query overall development, I think we're in a good place here. You could also argue that on queries that historically have not been well monetized, we think there's a potential opportunity here where you can obviously imagine that we can build this out with smart AI integration.
Our next question comes from Michael Nathanson with MoffettNathanson. Your line is now open.
Thanks. I have two, one for Philip, one for Anat. Philip, it's clear that when people use AI mode, the query length is much longer. Can you talk about how that longer length may be impacting your ability to drive ROAS and what you're seeing in terms of some of the benefits of maybe longer query length? And then, Anat, you came to Alphabet from a pharmaceutical company. You've been there more than a year. Can you talk a bit about how you're working to look at ROIC internally, and what early signs are you seeing that gives you confidence that this spending is really driving better returns longer term? Thanks.
Look, as Sundar shared, AI mode now has over 75 million daily active users in the US, and we see strong and consistent week-over-week growth in usage since launch, and the queries doubled over the quarter. And as I also mentioned, we're testing ads in AI mode. We'll continue to test before we expand any further. It's really too early to tell and go into any of the details of that testing.
Okay.
Yes, and the question related to ROIC and how we look at just overall our business and where do we see early signs that are encouraging. So first, I would say it's not just early signs because we're seeing returns, obviously, in the cloud business. You've heard us talk about the fact that we already are generating billions of dollars from AI in the quarter. But then across the board, we have a rigorous framework and approach by which we evaluate these long-term investments that are meant to do two things. One is to ensure we build a resilient growth profile for the company, but also that we meet the demand of the customers that we have here in the more near and midterm. So we look at it across the business. We evaluate the potential return for each one of them, whether it's in cloud, and I think that's more visible, obviously externally, given that you see the revenue generated and the fact that we're unable to meet at this point customer demand. We have more demand than we have supplied. In our ads business, you see the fact that we're investing to transform search, as you heard from Philip and Sundar with AIO and AI mode. So we're excited to see what our investments are, how the investors are helping advertisers as well. YouTube, where it's helping power recommendations. So when we make a decision on investment in the long term, we go through a very rigorous process of assessing what the return could be and over what time frame we will see that return to give us the high level of confidence to then invest and make those investments for the long term. So it's a very rigorous approach.
Thanks.
Our next question comes from Ross Sandler with Barclays. Your line is now open.
Great. About 20% of Google's search queries are commercial historically, and you've talked a bunch on this call about how AI overviews are kind of expanding the breadth of queries. Could you talk about how new products on the monetization side, like AI Max, are potentially increasing the percent of commercial queries?
So, look, AI Max, and I mentioned this in my call before, improves the ability for advertisers to target a wider range of queries. Separately, there is the question of whether queries actually increase with AI mode, and Sundar actually talked about it and mentioned the opportunity that he sees here. So I think it's important to separate those two things. And I personally also see, this is what I just said in my last remark, that I think over time there's an opportunity to actually take, let's say, queries that are not fully commercial, but could have an adjacent commercial relationship to basically expand this into more attractive ads offerings while really creating a really interesting user experience at the same time.
Yeah, and the only thing I would add is just stepping back broadly, I think AI overviews and AI mode are, dramatically improving search. We can see it in user satisfaction, user quality, all our metrics, and they're universal in the nature. They apply across the universality of human needs. So I think we are seeing it in breadth, and so naturally over time that'll apply to commercial categories as well.
Our next question comes from Ken Gawrelski with Wells Fargo. Your line is now open.
Thank you very much. Two questions, please. First, it appears more and more clear that all the new modes at Google with Gemini overview, AI overviews, AI mode, even ChatGPT is growing the addressable market for engagement in search-like behavior. Could you talk about what gives you confidence that it will also grow the addressable market for marketing activity and overall revenue associated with that behavior? That's question one. And question two is just more about, as you think about AI mode, AI overviews, and traditional Google search, AI overviews and traditional Google search, and AI overviews and traditional Google search, and AI overviews and traditional. Does the user eventually pick what mode they want? Does the algorithm pick the mode? Can you talk a little bit about how you think that will progress over the next 12 to 24 months? Thank you very much.
Ken, thanks. Look, I think it's a dynamic moment, and I think we are meeting people in the moment with what they are trying to do. Obviously, search is evolving, and between AI overviews and AI mode, I think we are able to kind of give that range of experience for people in this moment. Over time, you can expect us to make the experiences simpler, to make the experience in a way that, just like we did universal search many years ago, we may have done text search, image search, video search, etc., and then we kind of brought it together as universal search. So you will see evolutions like that, but I think we want to be sensitive to making sure we are meeting the users in terms of what they are looking for. I think Gemini allows us to build a more personal, proactive, powerful AI assistant for that moment. And I think having the two surfaces, Search and Gemini, allows us to really serve users across the breadth of their needs. But over time, we will thoughtfully look for opportunities to make the experience better for users. And to the first part, I would broadly say, I do think we've been consistently saying for a while now, this is an expansionary moment, and we are seeing people engage more, and I think when they do that, naturally a portion of that information for users, those journeys are commercial in nature. So I would expect that to play out over time as well.
Our last question comes from Justin Post with BAML. Your line is now open.
Great. Just a couple. Sundar, I think you mentioned Gemini 3 is coming. Maybe you comment on the pace of innovation in frontier models. Is there still just a tremendous amount of innovation, or is it slowing at all? And then you mentioned, a number of large deals signed in the last 9 months for cloud, which is great. Any changes in the economics of these deals as far as long-term profitability? Anything we should be aware of? Thank you.
Thanks, Justin. The first on the pace of frontier model research and development. Look, I think two things are both simultaneously true. I'm incredibly impressed by the pace at which the teams are executing and the pace at which we are improving these models. But it also is true at the same time that each of the prior model you're trying to get better over is now getting more and more capable. So I think both the pace is increasing, but sometimes we are taking the time to put out a notably improved model. So I think that may take slightly longer, but I do think the underlying pace is phenomenal to see, and I'm excited about our Gemini 3.0 release later this year. On cloud, I would point out, as a sign of the momentum, I think the number of deals greater than $1 billion that we signed, in the first 3 quarters of this year are greater than the 2 years prior. So we are definitely seeing strong momentum, and we are executing at pace. And in terms of long-term economics, I would say that, again, us being a full stack AI player, and the fact that we are developing highly differentiated products on our own technology, I think will help us, drive a good trajectory here, as you have seen over the past few years.
Great, thank you.
Thank you, and that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any further remarks.
Thanks everyone for joining us today. We look forward to speaking with you again on our fourth quarter 2025 call. Thank you and have a good evening.
Thank you, everyone. This concludes today's conference call. Thank you for participating. You may now disconnect.
All right. That was sorry, I'm trying to find the tab. Oh, there it is. That was crazy. I was not expecting the Google earnings report, Alphabet earnings report, to be that good overall. I just think that it's been absolutely phenomenal in terms of how it's shown up and obviously it's showing up. I think where is it at? I mean, the stock is hanging out at 292.50. I'll bring it up on the screen here really quick. But yeah, 292.50. You know, what more can you ask for in terms of performance of the company? I mean, it's continued to do well in that respect. And you know, with ops margins increasing in cloud, that's one of the key things that I was particularly focusing on, growing from 17% a year ago to over 24 or close to 24%, not over 24%, close to 24%. I mean, geez, what more can you ask for? And if you looked at it in comparative to how Microsoft's ops margins are showing up, they're in the mid 30s. And so if you think about the run rate, which is at 60 billion for Google Cloud and just shy of 200 billion run rate for Microsoft, I mean, you are in third place, but if you have the opportunity in a few years to grow to that $200 billion run rate, which based off the call, continue to get more and more customers, over $1 billion, many more $1 billion contracts than they have in the history of the company. You're really starting to potentially do well in terms of long-term trajectory for the Google Cloud business itself. Stock's trading at $3.3 trillion market cap, doing well in that respect. And to me, you know, I was fortunate to buy some shares over the past year or so in the 150s, 60s, and 70s, but unfortunately didn't buy enough. You know, I don't have nearly the size position that I would like to have. Just like Amazon, I would love to get this up to a position where it could easily be $1 million position. But this thing's already starting at 3.3 trillion. So do I think it's going to hit 10 trillion? I don't know. You know, I feel more confident that Amazon will hit 10 trillion before Google does. Not that I dislike Google, but the way I'm looking at it now is I think Google likely more of like an $8 trillion market cap from what I'm seeing right now. I still think there's headwinds. There's going to be some competition with advertising being eaten up. I'm not saying search is going to zero. I think that's what a lot of people were saying about a year ago. But you know, you have Amazon ramping up their advertising business. You have Microsoft ramping up their advertising business. It's getting tough. It's getting tougher out there. So it's not as easy for an Alphabet to continue to do well. So appreciate the 30 of you guys watching pretty consistently. I posted in the chat there, Kick. If any of you guys watch on Kick or have a Kick account, please feel free to lock yourself over there or walk yourself over there and hit the subscribe button over there. Just trying to diversify in case, you know, anything ever happens, or trying to, as always, just interact with as many people as possible. I don't think that people recognize the value of just being able to sit and have conversations like this. When if you were to bring this up at you know, when you're trying to watch football at a buddy's house, they tell you to get the hell out, you know. So it's a community that I continue to want to build across Twitch, across Kick. I'm not asking you to move over to those platforms or anything like that. I'm never going to be specifically streaming on Twitch or specifically streaming on Kick unless I say get kicked off the YouTube platform. But I just want to make sure that I have the ability to reach as many people as possible. And a lot of people have been benefiting from the stuff we talked about with Rocket Lab and Palantir over the past 5 years. And so I just want to make sure that we have every avenue available to people to succeed in this world. And so having that on Twitch and having that on Kick is useful as well. I did like the Meta call. I did think that it was interesting that it seemed like it was a surprise for this one-time tax item. You know, the analysts call the CEO, and you have these road shows. You know, maybe they've just been too focused on delivery. Maybe they don't give a shit about, which is fine if this is the case. They don't give a shit as much as you know, getting and, you know, tuning into the analysts' ears and stuff like that. They just want to do what they're doing and deliver. I get that. You know, sometimes you just need to focus on you, and the dollars will take care of themselves. And so maybe that's the case. But you know, I'm used to hearing about, you know, the CEO having these road shows and calling and making sure that they kind of give people insights as to what's going to happen for the quarter. You know, obviously not giving numbers or anything like that. That's obviously you can't do that because somebody has proprietary information that's not publicly available. But at least feeding out that, hey, something's going to be coming, right? Like, the big, beautiful bill that obviously has impacts across a multitude of businesses. Maybe you should potentially look into something like that and how that could impact our business. We're looking into it as well. And so there might be something associated with it. You're not giving secret information at that point, but you're at least giving a heads up that says, hey, you shouldn't be expecting $18 billion in net income for the quarter. You should be expecting something that's impacted by a potential one-time tax event. And there's that, right? I think that's very important for people to kind of understand. So appreciate there's only 30 of you in the call. That's great. I don't mind that. That's fine. I'm curious though. Put a 1 in the channel chat box if you didn't have any midstream ads throughout the entirety of the past several hours that we've been online. Been live about 2.5 hours. And then 2, I've tried to get the microphone quality to sound a little bit better. So if it does sound a little bit better than when you've talked to me in the past it's been a little bit tinny. And my hope is to give a little bit more bass. So the people that are, I was listening to somebody's podcast yesterday. I was like, that sounds phenomenal. Like, what do you do? So I did a little bit of research associated with like, how do I make this sound better? I have a decent mic. The mic is not horrible, but there's some inputs that you can do in the background to make it sound a little bit better. So just want to continue to improve for you guys. So when you guys are watching, I did want to go through, and before I sign off, I know that there's others that are continuing to stream as well, but I did want to go through and look at some of these items that have come out on CNBC today because I didn't have the opportunity to watch everything. I really just tried my best to come home and really try to knock out the earnings calls. And so there's a few things that I wanted to touch base on. And there's some turmoil in the room during the Fed meeting amongst the Fed board about specifically, what is going to happen in terms of December cuts. And it seems like there's uncertainty around that. And so let's take a quick look specifically around that particularly. Like what exactly is going on and what can we expect going forward associated with that? Let's take a look.
Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
All right, so there's that piece, and then of course there obviously was a big tax item associated with what happened with Meta, and I'm curious to see what analysts say. They're saying that they beat in terms of earnings, which I thought was interesting on CNBC. But obviously, there's the one-time tax item. So curious to see what they have to say about
Meta
that.
Results are out. Stock is headed lower, and we can go to Julia Boorstin on that right now. Julia, I wonder if you can see why the stock is down 7% or so.
Well, earnings and revenue both beat expectations. Adjusted earnings of $7.25. That's ahead of estimates of $6.69. But that includes a one-time non-cash income tax charge of $15.9 billion. But that without that one-time charge, which is due to the big beautiful bill, President Trump's big beautiful bill, that would have been an EPS beat. Revenues also ahead of estimates. Daily active people ahead of estimates, 3.54 billion versus 3.49 billion estimated. And the average price per ad was up 10% in the quarter versus an 11% gain that the street account estimate had anticipated. Now, in terms of Q4 revenues, the company is guiding to Q4 revenues between 56 billion and 59 billion. That compares to the 57.25 billion estimated. And they say the outlook reflects an expectation for continued strong ad revenue growth, partially offset by lower year-over-year Reality Labs revenue in the fourth quarter. We're going to continue to dig into this. Does seem like everyone is working through this one-time non-cash income tax charge and its impact on the company, as well as some other factors. Back over to you.
All right, Julia, thanks. That stock still down more than 6.5%. Microsoft's off the lows, but still down nearly 3%.
All right, so that one was interesting. Curious now, I think, where people are at, right? This obviously has this one-time tax item. Welcome to the people that are tuning in from a midstream. It just ended, it looks like. So an influx of people from like 20 some people to now ramping up above 70. So I appreciate you guys hopping in here. I know it's been a long earnings call season, so I'm sure some of you guys can stand up, take a break, grab a drink, hopefully hit the bio really quick, but excited that you guys are here and tuning in with me. But I'm curious to see what this means for people when it comes to playing into Meta. I myself bought one share. Just keep track of the company. I'd love to see it continue to go into a downward spiral for a little bit. I think I'm still cautiously optimistic that the company will do well, but curious to see how others will be playing it for this. So let's see here what they had to say on Fast Money.
And saying it expects to spend even more in 2026. The conference call is underway. For more, let's bring in CNBC's Julia Boorstin. Julia, any guidance on 2026 CapEx?
Well, CapEx is really a big focus of the call right now. CFO Susan Li talking about it quite a bit. Both she and CEO Mark Zuckerberg talking about why they are raising their CapEx, saying it's all about investing to drive AI strength and how they need to maintain that position of strength. So they raised the range for 2025 capital expenditures to a range of $70 to $72 billion. That's up from a prior range of $66 to $72 billion. And the company did not share specific guidance for next year's CapEx, but CFO Susan Li just said moments ago on the call about the importance of expanding infrastructure capacity to enable Meta to seize opportunities, saying they expect CapEx dollar growth to be notably larger next year, saying, quote, "We are focused on preserving maximum long-term flexibility to ensure we can meet our future capacity needs while also being able to respond to how the market develops in the years ahead." Now, Lee also saying they expect to invest aggressively to meet those needs, both by building their own infrastructure and by contracting with third-party cloud providers. Now, that could indicate more cloud deals ahead, and Meta has done some big recent cloud deals, a $10 billion deal with Google in August, $14 billion deal with CoreWeave in September, and a $20 billion deal with Oracle in September as well. So, Melissa, now a new category of stocks that might be impacted by all these AI investments.
Yeah, Julia, keep us posted on the call, which is about 38 minutes in. Julia Boorstin. Once upon a time, higher CapEx was rewarded definitively by the stock market? Have we hit a point, Michael, in your view, where we are reassessing? We need to see ROI, and it is the turn here in terms of CapEx numbers.
Yeah, Melissa, I think that's absolutely the case. I think we're going to see more and more of this over the
Thank
coming
you.
quarters. You know, many of these
Thank
tech
you.
stocks, the tech sector in general, was so attractive for so long because it was viewed as CapEx light, and now it's CapEx heavy. You know, it's very similar to like an energy and exploration company within the energy space that constantly has to drill new wells in order to realize growth. These guys are all saying we have to invest ever larger amounts of CapEx in order to keep up with AI growth. And I think the value proposition, once you get to these levels, starts to diminish and the return on investment becomes much, much harder.
Yeah, Karen.
Yeah, so this is sort of what I was afraid of, that earlier on, CapEx was seen as good. What does the word notably mean here? I don't know. I'm scared
Sounds
of
like
it.
a lot.
I feel like notably is more than 10%. That wouldn't be notable to you, would it? I don't know. It seems like more than 10, which is, I think the street was looking for maybe, I don't know, a little over 10%. I think it'll be more than that. I mean, the underlying business is really doing well. They are getting returns. We see growth there, but I don't know that we're getting the returns on this kind of spend yet. So it's concerning somewhat. I think we'll hear what they... I feel like they should just rip the Band-Aid off. What do you think the number's going to be?
Right.
Okay, they should tell us what they think the number's going to be for CapEx.
I mean, the backdrop, though, is Meta has always been given sort of the luxury, the benefit of the doubt, because every dollar of CapEx would benefit their own bottom line. But we were talking earlier about, Llama 4. Not so great. I mean, so what are the results of all this spending?
Yeah, I mean, Meta AI is like a distant behind all those other chatbots that we're seeing right now, and they're trying to fix it. They went out to spend hundreds of millions of dollars. They want to do this research lab. They're kind of saying, don't look here right now, look there. We want to do super intelligence. And, when you talk about what they're getting out of this, obviously, like ad targeting has been really good. I think a lot of the metrics are demonstrating that. At a certain point, you're kind of going to hit a wall, and then they're going to have a lot of competition. If you think about how is OpenAI going to monetize ChatGPT, they're going to get in the digital ad game. Like, that's going to be a big way of how they do it. So you're going to see pressure around the whole space. But the one thing I'd mention about this build out of these data centers, they're just now starting to hit the debt markets, right? And you think about this deal that Meta just did to build this data center in Louisiana. Well, they're basically taking a 20% stake. There's going to, Blue Owl is lending them $27 billion. It's going to go into a special purpose vehicle. And, it's all this stuff, man. And some of that debt is literally going to be issued at 1% above. Like, it's going to be, Mike can get in here, it's going to be like junk. And then it's going to find its way into all these ETFs and all these big, debt portfolios. So all of this stuff is becoming very financialized. And we've been talking about this for a couple of years. These companies have been funding this build out through their cash flow and through their large cash balances. And now it's hitting a wall because 30% of their revenue, it's got to stop at some point, right?
Thank you.
This is, to me, the spot. And Oracle is in the worst spot of all of them. I think their debt to equities are like 500% or something like that. They're going to be the ones holding the bag, then the neo clouds, and then these guys, because they've done this off-balance sheet stuff, it's probably going to end up pretty good for them.
Yeah, this is where you get the parallels to the late 90s and early 2000s. You had a tremendous amount of debt issuance going to build out basically the fiber optic network that became Fios and everything else. Now, in fairness, you had companies doing this that really had no business levering up their balance sheet and ultimately went bankrupt. And I don't think we're worried about that with respect to the Mag 7 and some of these larger tech companies. But the story still rhymes. And you are starting to see a lot of this debt. You're also starting to see guarantees now from some of these players to smaller, infrastructure companies, construction companies, et cetera. And that's a new thing that we're seeing in the debt markets. Guarantees by Google for someone to build out a data center and issuing debt in order to do that. That's something that's never been done. That always makes me a little bit nervous.
So they took a $16 billion charge. So if they had not taken that, EPS would have been probably 10% better than expected. It would have been $7.25. The street was at about $6.65. They beat revenues by about, I think, 4% better than the street was looking for. Margins are now north of 40%. I get it that people are concerned about the spend. Where are they going from 69 to 71 billion? I mean, to me, that's a bit of a rounding error. But I understand this level that we're looking at now is where we traded down to at the end of July and held. So I actually think you buy Facebook here.
All right. Yeah, some people are probably curious why I'm screaming while you guys are watching this and enjoying and trying to understand the amount of capital spend that people have been really forecasting has just been going up and up and up. And I think everyone just assumes like AI is not done. AI is going to continue and we're only, like I saw a clip earlier on CNBC. We're not going to watch it, but it says we're in the second inning. It's like, I don't think we're in the second inning, my guys. Like, and granted, yes, AI has a long wavelength, right? But maybe AI as a whole, second inning, yes. But in terms of this business cycle, in terms of before we see some sort of recessionary pressures, there's going to be more. We're basically on. I don't want to say we're at the back end of it. We're not hitting some sort of backstop, but no longer do you have this free cash flow that you can just tap into. You're starting to see Google go into their, like, Google's raising it to $90-some billion. Next in this quarter alone, they spent over $25 billion. They're forecasting for the entirety of 2025 $90-some billion in capital expenditure. Keep in mind they also are going to be buying back $60-odd billion worth of stock, and they're also going to be giving out dividends in the order of $5 to $10 billion. So where's all that money going to come from? They no longer have the free cash flow to be able to fund these things. So it's something I've been talking about with Steve, and Steve's just like, oh, they're fine. And it's like, I get it. At some point, though, you're going to run out of cash. And so, yes, you're going to see some benefit of, say, 20%. But just because you invest, let's say, on your invested capital, it's going to take time to build that infrastructure out. It's not going to show up immediately. And so my fear is that you're going to be expecting from NVIDIA and all these other players, say 40% year over year revenue growth. And so they warrant a price to earnings multiple of, say, high 30s, low 40s, maybe even 50x. But yet we're hitting a wall. And I think that people are starting to finally see it. At least CNBC Fast Money is starting to see that, oh crap, like these guys are actually starting to have to dip into their own pockets. Not longer are they going to have the free cash flow. And I come from a world where it's very capital intensive in oil and gas. And you really have to balance, you've been in a world since that you can just increase dividends, increase for software companies, increase the dividends, increase the capital expenditure, increase the buybacks, because if you just do it at a steady pace, but they've ramped up capital expenditure so aggressively for these companies that you really have just now to start use the capital. And that's why you have capital on the balance sheet, to be honest, is times like this where you see points of opportunity where you could get ahead of maybe your competitors. But I think it's more so about investing through the cycle than getting ahead of it. And what I think is going to end up happening is the people that are being more strategic about investing through the cycle are eventually going to be the ones that succeed the most. And you're going to end up having to see some people that are going to go through issues with buyback cuts or dividend cuts or something of the like, where they run out of capital and actually have to go into an expansive amount of debt. And I don't know, it's just it's an unprecedented territory that we haven't been in with software. And I think that people have just continued to think that we're okay. Anyway, yeah, I just think it's pretty interesting in that respect. And I don't think that people have been talking about it enough. They keep seeing, oh, free cash flow is fine. But you have to think, like, the dividends aren't taken out of the free cash flow and the share buybacks. And you've already promised that if you really think about how much they've already promised to the people, that you're already running up against a wall. And so I think Meta's hitting that point. Their free cash flow is really starting to hit a point where they've already outspent it. And I'm curious to see where they end up. But like the fact that you're already seeing a $91 to $93 billion in CapEx from Google, and they stated that they're likely to go higher in 26. Well, their whole net income, if you think about it, for Google is like going to be probably on the order of $130 billion this year, which is phenomenal. But you promised already the investors that you'd be buying back $70 billion worth of stock, and they haven't been buying $70 billion worth of stock. They've been buying back 60 to 65 billion. So you're already under you're already under achieving that the actuals in terms of share buybacks, and now you've already introduced a dividend. So you're putting yourself in a corner. And I don't think people are truly looking at this. They're just continuing to look at, oh, well, if you look at free cash flow, they can increase CapEx to Kingdom Come. But it's like, you think that, that you just saw Microsoft increased the amount of dividends and buybacks that they did this quarter. So at some point, you hit some sort of wall. And I think, unfortunately, software companies were taken by surprise of the opportunity set in front of them, and they expanded maybe on buybacks too quickly. Now, maybe if you reduce the buybacks and you increase it into CapEx, that people might actually be genuinely excited about that. But I think that there's going to be a negative sentiment like, oh shit, these guys actually may be not as great of a financial fortress as once thought. So I don't know. That's part of the beauty of buybacks. You have a little bit more leniency on being able to trim back and pull back on buybacks than you do with, say, dividends. Because dividend investors, like, yeah, you don't want to miss the dividend. Like, you can't cut dividends. So anyway, curious to see. We didn't have the opportunity to watch the NVIDIA chat yesterday, but a big announcement. Now, this isn't a surprise to me, but maybe it's a surprise to some of you guys. And then I'm going to text my buddy, Stephen Fiorillo, and see how he's doing, and see if he wants to potentially to join us. And then maybe eventually you guys can transition over to his channel. He's not live now, as far as I'm aware, but my hope is that maybe he wants to do and piggyback off of a quick live off of me. Would be able to give you guys the opportunity to hang out with Steve if you haven't already. So let's just talk about this Palantir NVIDIA Lowe's operations deal that they were kind of talking about at the chat yesterday.
Palantir and NVIDIA are revolutionizing the way businesses operate, unifying and processing critical data faster and at scale. Palantir's Ontology builds a digital replica of your business, seen through a single pane of glass, where every decision gains context. By infusing NVIDIA accelerated computing, AI, and CUDA-X libraries, actions are optimized with intelligence. America's largest retailers, including Lowe's, streamline their operations with NVIDIA AI. Behind every aisle lies one of the most complex global supply chains, 7,500 vendors, 130 distribution centers, a nationwide fleet of trucks, and over 1,700 stores. Orders must be placed months in advance. And while changes are anticipated, it's costly to adapt. Weather in the Pacific delays shipments by weeks. With NVIDIA cuOpt, Lowe's re-optimizes the plan, identifying alternative routes by reallocating shipping capacity to where it is needed most. NVIDIA Nemotron reasoning agents analyze multiple plans, then recommend the best path forward based on cost, availability, and need. But by the time it docks, demand has shifted, and plans are automatically re-optimized once again. Powered by Palantir Ontology and accelerated by NVIDIA AI, America's industries can adapt instantly and thrive globally.
All right, pretty cool. That dashboard that you guys saw in the background was Foundry. If you guys haven't been paying attention to what I've been sharing in the past and some of the videos that have been coming out of Palantir, that was a Foundry instance pretty much that Lowe's has kind of created. So pretty cool to be able to see that. But yeah, so I think it's pretty funny. We had some people be like in the chat earlier, like, oh, should I buy Google? And I'm like, dude, like, where have you been? You know, like, it's been part of my top 5 positions, right? I don't have a lot of positions, but let's go through the chat. A couple people have joined, and I really appreciate you guys coming over from Amit. I know he's the star of the show, and he does a great job. So appreciate that. You know, he has a better chat than I do, and the community over there is phenomenal. But excited to see that some of you guys were able to make your way over. So Namohad, pleasure to see you over here. Peter, what is going on? Thank you for joining. Miss Junebug, we got Jared. Thank you for being a continued watcher. Much appreciated. Meta has no money from the Derpy Rock. Thank you for showing up and chiming in. The wealth building vibe. Welcome, welcome, welcome. SmackDown, we got analysts. Let's see. We got Miss Julie. We got DJ. We got Junebugger. Wings, though. Mox. Wintho Mox? I don't know, but it makes me hungry for some chicken wings. I'll tell you that much. I had some salmon for lunch, but it was very light, and I didn't eat all of it. So your boy's tummy is rumbling. Synthrix, what's going on? Miss Tess, what's going on? Miss Michelle, inbound. Let's see who else we got in here. We got Hot Tevis in here. The man who refuses to buy the stocks that I like to recommend to him. Not financial advice. We got Jack Strehorn. Thank you for continuing to be a great person. Thanks, Tess. I didn't know you remember. Well, actually, that's a lie. I knew you remember. I appreciate you being a member for 6 months. That's awesome. We got Hot Ray. We got Jarrett. Jarrett's watching over on Twitch. For any of you guys that, not saying you have to, but we got the Twitch community, and I always try to make an opportunity to get into every community possible to try to help anybody. So maybe some words over there in the Twitch community, we can find a whole new group of people that we can help, and that's the most hopeful thing that we can have, right? Just help people up the learning curve. That's the purpose of the channel. Tavis's line. I'm not humble. I'll let people know when they F up and you messed up. No, I'm just kidding. Let's see. G10, what's going on, my guy? Yeah, he ran out of steam after 9 hours. Yeah, I think he was streaming pretty much all day. Thanks, Tess. You didn't have to do that. I appreciate you. I really do appreciate you. It's much appreciated. Happy Me Fly. We got Steely Speckle. Look at his eyes. Yeah, exactly. Yeah, now that you guys are here, let's replay the intro. We got a couple minutes here, and sorry that we didn't do Cashflow Chronicles last night. I completely forgot, and Chris never messaged me. I thought something was happening. I was like, I have a lot of free time today. It's Tuesday. I don't know why. And it completely slipped my mind. So we'll be right back after this.
That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving!
Sell it all today.
Or look at it say, it's beautiful!
Welcome to the fucking show.
All right. So let's just take a quick look at what other opportunities we have to look at some clips before. My hope is, my honest to God's hope is that we have the opportunity to watch a few clips from CNBC, catch up, and after that, hopefully turn it over to Mr. Fiorillo. He's avoiding me. He hasn't texted me back. So I don't know. My hope is that, he gets a really good showing over there. He's been averaging 350, 400 people on his streams, and I just want to make sure that, he doesn't need my help by any means, but want to make sure that if I'm going to be, handing over, like you guys came over from a mid, if I can hand over to somebody, then I would love to hand it over to Mr. Stephen Fiorillo, my buddy. So for any of you guys that haven't followed Steve yet, I'm sure most of you have. If you haven't, I don't know where you've been, probably living under a rock. But Stephen Fiorillo started his own YouTube channel. He's up and he's catching up to me pretty close. He's over 9,000 subscribers. I anticipate by this time next month, Hot Steve will have as many YouTube subscribers as I do. I'm just at 17.5-ish or so. Nick, thank you very much for becoming a member. Didn't have to do that, but you did, and I appreciate that. But yes, happy that I have the opportunity to come home and hang out and talk stocks with you guys. I don't often get to do it, but I wanted to make sure I do that. Let's see. What other things can we talk about on here? Let's see. I'm curious to see what Stephanie Link has to say. So let me pull up this particular thing from CNBC here.
You own it. Now, this is a stock that I believe is down 34% year to date. So if people are wondering why it's up on results that seem more disappointing versus expectations, some of the big tech names, perhaps it's being measured by a different standard, Stephanie?
Oh, absolutely. Absolutely. Look, I mean, it's hard in general for this industry right now from a macro point of view. But they're doing the very best that they can. I think that the expectations were for a negative comp for the quarter. So to be kind of around flattish is not a bad thing. I think they're kitchen sinking the low single-digit declines in same-store sales for the next quarter. Restaurant margins are coming down, but they're still industry high. They have, I believe, $500 million left in their buyback, or 1% of the market cap. So, I mean, they're doing the best that they can in terms of delivering on the cost structure. They've got products, they've got digital, and they've got a menu that they're revamping as well and adding to. And I think that will lead to better comps going forward. But this is absolutely classic, terrible expectations because the stock has been terrible year to date.
All right. And I know those comp sales are what were in focus for Starbucks, too, talking about turnarounds and lower expectations. I want to get your thoughts on what we saw with Meta, with that stock trading lower right now. I mean, higher CapEx for 2025. It's going to be even higher next year, but a lot of noise in this quarter with that cash charge.
Yeah, I mean, look, I think the numbers look pretty good in terms of the growth, but people have always been very sensitive to this excessive spend. And so for them to increase their CapEx to 116 to 118 billion for this year, from 114 to 116, that's a disappointment, number one. And number two, to be notably larger in 2026, that's not going to sit well with people. We just want to see operating leverage at this company, and we had been seeing that over the last couple of quarters. This is actually a departure from that, and I get it. They're building out data centers up the wazoo. They're hiring all kinds of talent for AI. They're doing it for the long term to continue to grow. But I think, near term, it's disappointing. Now, I would say ad impressions actually up 14%. That's a good number. That's a really good number, better than expected. And pricing of 10%, that shows that they're monetizing AI. And they're one of the very few that are spending all this money that is monetizing. We just don't want to see them spend this much.
But Stephanie, the flip side of this, isn't it? I mean, you got NVIDIA touching that $5 trillion market cap, in part because folks like Meta, and there aren't that many, but folks like Meta are spending all that money on the infrastructure. So do you see anything here that's either derailing or bolstering the AI storyline that's been powering this market so much? These big names are continuing to spend. Meta perhaps seeing some results out of that. I don't know if the intelligent cloud mix out of Microsoft causes any concern, or if we have to wait for detail on the call to hear exactly what was going on with that.
Look, I think the spend is there, and it is gradually increasing, probably at a little lesser rate than that had been growing at. But they're still spending because the demand is still there. We're in the second innings of this. So it depends on which way you want to play it. You can play it with Mag 7 because they're delivering on the growth side, some monetization. They're delivering on the free cash flow, and they are investing for the future. Or you could go downstream in terms of technology. You've mentioned NVIDIA. Look at Broadcom. Look at Teradyne today, up 20%. We don't even talk about them. Then we go into Morgan's world on industrials and look at all of the grid manufacturers or improvements that we're going to see. Look at the data centers that we have to build. Look at the power that we need. So you can own things like Quanta Services and Eaton and Rockwell Automation and GE Vernova and Vertiv, which is one of my favorites. So you could do that, or you could even go to the utility companies. So you're seeing spend across the spectrum of between tech and between utilities, industrials, and that's why I don't think it is a bubble. But, certainly the ones that are spending more, and we don't want to see them spend more, that's why they're taking a hit. By the way, Microsoft, I think, is down only because Azure grew 39%, but the last couple of quarters, they have been beating expectations by 300 to 400 basis points, and they only beat by 200. So, I mean, really, that's silly. If the stock is down just because of that, you buy that stock.
Hey, Tone, why should people come to the AI Advantage Summit November 6th, 7th, and 8th?
That's a good ad, isn't it?
Where's it at?
Pretty simple.
There it is. All right. Where was I going to say? The one thing that I wanted to pull up specifically is the FOMC obviously is heavily impacted by rate cuts and what we've been seeing associated with that. And it seems like, at least from what Jerome Powell is presenting, they seem to be divided amongst whether or not they're actually going to continue into December or not, which I thought was pretty funny. He said, we haven't decided on December cuts yet. It's like, well, obviously you haven't, right? You still need to meet on the 9th and 10th, which I thought was pretty funny. But obviously I think a lot of people started to very much panic. And that's why the market took a little bit of a tumble towards the end. And you started seeing some companies, very, very rate sensitive companies, start to take a hit towards the later half of the day. And I think a lot of that had to do with, oh my God, maybe rates aren't going to come down as quickly. But I think that we're still on a very good path to do things well. So yeah, let's just get the opportunity to pull that bad boy up, and we will play this clip. Curious to see what they had to say, what their notes are on this.
After the Fed cut interest rates this afternoon, all three indices hitting intraday records early, but only the Nasdaq stayed in the green. The S&P nearly unchanged, the Dow down more than 70 points. Nvidia making history, becoming the first company to hit a $5 trillion valuation. It is up nearly 50% in just the last 5 trading sessions. Gold, meantime, settling back above the $4,000 level today, but pulling back in the last few hours. Shares of Adidas dropping more than 10% on weak sales in North America. The CEO saying nervous U.S. retailers were ordering less product up front as they waited to see the full impact of tariffs. And some more after-hours action. MGM missing earnings estimates. eBay lower after topping EPS and revenue expectations, but cutting Q4 earnings estimates. And Carvana dropping despite a revenue beat. Well, Fed Chair Jerome Powell throwing some cold water in hopes of a December rate cut if economic uncertainty remains high. Traders now pricing in a 30+% chance that rates stay unchanged at the central bank's final meeting of 2025. Let's get to Steve Leisman in Washington, D.C. for more on the decision today. Steve.
Hey, Melissa, yeah, a divided Fed cutting rates by a quarter point to a new range of 3.75 to 4% as expected. But Fed Chair Powell disappointing markets in the press conference by signaling a far more neutral stance on a December rate cut than had been priced in.
In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
That comment triggered an immediate sell-off in stocks that had barely moved from the statement a half an hour earlier, and also a surge in bond yields as markets repriced for the chance of no December cut. The chance of that cut falling from 84% before the press conference to around 67% now, but the probability that it happens in January rising from 42% to 80%. So the direction priced in from markets, that remains intact. The pace is in question. The Fed noted the lack of data resulting from the shutdown, but seemed more focused on the data it does have, showing reasonably strong economic growth, a booming stock market, and no acceleration in the softening of the job markets that they can tell. The vote coming with 2 dissents, one by new Fed Governor Stephen Miron. He once again wanted a 50 basis point rate cut. And from the other side, by Kansas City Fed President Jeff Schmidt, staking out a hawkish position, favoring no rate change. It's unclear right now what the default position is. If the alternative data continues to show no change in the current read in the economy, the Fed may take a Christmas break from cutting, Melissa.
Yeah, it was also interesting to me, Steve. Powell made it sound like the lack of government data is also an argument to stay on the sidelines, to not move. So he was almost throwing it back to Trump, saying, this shutdown is going to make me stand pat.
I think that's part of it, but it's also interesting to see to listen to what he said about the data he does have. We do get those weekly jobless claims. I'll bring them to viewers on Friday morning. They really showed no acceleration. There's also some data on job openings not getting much worse. So the real question being asked in monetary policy terms is, has the Fed taken out enough insurance against a potential weakening in the job market, not an actual weakening?
Steve, it's Karen. Thanks for being on. How much dissent could there be versus what you've seen historically, and that they would still move forward? Is it just a simple majority, or and what if you have dissent on both sides and you don't get a majority? How does it work?
It's a great question. And I will point out that as I reported all day today, that the market may end up being disappointed with the guidance. That reporting came from the comments of Fed officials, in fact, Fed presidents who are voters, many of whom wanted to be cautious. So we have to listen to what people are saying rather than seeing what we want to see. And I think the market has a predilection to do that every now and then, which is it wanted to cut, it wanted the guidance for December, and so it thought it was coming and kind of ignored some of the cautionary signals that were out there that maybe we weren't going to get that guidance that that the market had wanted. So I think Fed Chair Powell has engineered his committee with far fewer dissents than Bernanke or Yellen ever did. It's something that he seems to strive for. He wants to bring the committee together around a consensus with a couple dissents on the side. And I think you're right to ask this question precisely, which is this notion that once dissents get too high, I think the Fed chair would probably, if it's not in favor of a cut, he would back off.
All right. I think that was good enough. The one thing I saw that, the thing that I saw that intrigued me about that one, which I tried bringing up on my screen. Apparently you cannot do this, but I wanted to bring up the prediction markets. So we saw that people are obviously moving in the different direction associated with the rate cut. So that note that we haven't been decided yet. I think that's just like hey, like, you can't predict it, right? Before you can't say it's done before you actually have the meeting, right? So to me, like, I think that was obvious. I took a gamble. The market, if you look at it in the last day, this is what it looks like. So the Fed decision, sorry if it's in reverse, but Fed decision basically went from being 85 cents to now 67 cents. So that's basically an 85% chance to now a 67% chance. So people definitely pulling away. So I decided to buy 1,000 contracts, and if it goes up, a little bit, I'll probably sell it. But so I basically spent $680 thinking that, okay, I think that I'll win and get my $1,000. Worst case scenario, I lose a little bit, but I thought it was interesting. You can't pull that up on desktop. Otherwise, I'd pull it up on desktop. Some things I wanted to share with you guys. I can't believe he did this to me, man. I cannot believe he did this to me. Why you got to do this, man? Sorry, my mouse spin wheel is messed up. But Jim, why you got to do this to me, man? Jim Cramer officially increasing the price target on Palantir from $200 to $250. And earlier in the day, he said he was thinking about it, right? And I was like, don't do it, Jim. Like, we're boys, right? We're boys. You don't have to do this. But here he is. We always say Palantir to zero, right? We've been saying that for 5 years now since it's gone public, and I've been buying it. It's going to negative, right? Like, why is this guy doing this to me? So let's see what some of these things we got. Emit. All I can do right now is put on a brave face. Very funny. Let's see. Why are these GIFs like showing up as like really horrible quality? This one's pretty good. Sound too bad. Let's see. The polite and tester, and that was interesting. Don't know. We got Peter Thiel. Got Uncle Kramer. Palantir about to go off a cliff. Got Uncle Dan over here looking good. So pretty funny. One thing that Johnny Utah shared with me yesterday, which I thought was nice. So let me just get it up in the background so I don't share any like private conversations by accident. Is something from Next Decade. I did not see this one. Actually, I thought this was pretty funny too. Austin made this. Obviously, I was sharing a lot of information about Google during the stream, and I saw Austin made this. He put it in our mod chat for Amit's channel as well. I thought it was hysterical. I love these things. I think it's just so funny. But yes, let me get in the background. So Johnny Utah provided to me yesterday a graphic on next decade, and basically what it is what it isn't. No, I'm just kidding. So basically, next decade, for those of the people that are kind of following it, is an LNG company, liquefied natural gas company, that provides a lot of energy to Europe. And by the time I'd watched this video, only like 20 or so people had watched it. And so, why am I yelling? I hope I'm not yelling. I'm trying not to yell. If I'm yelling mid, like when they're talking about CapEx and stuff like that, yeah, you'll see. I explained it a little bit. We're not eating dinner tonight. No, I hope to eat something. Quick side note before I pull up this video for next decade. Your boy's pissed, so I got to let this out. I already talked about it earlier. I need to vent again. Okay. So you guys know I'm trying to get a little bit healthier, so I'm trying to eat a little bit better. But so I ordered a 6-piece boneless wing yesterday for dinner, and I still obviously had a lot of calories left. So I was like, okay, well, I'm still going to be hungry after that. 6-piece wasn't a lot, so let me get a salad as well. And I was like, okay, there's a place that opened up. It's called Texadelphia. It's basically trying to make like cheesesteaks and stuff. So obviously I can't order a cheesesteak, too much bread, etc. But I was like, I could still at least order the beef, like the shredded beef on top, no cheese or anything like that. I was like, and it wouldn't be that horrible, right? And so ordered a side salad actually it wasn't a side salad, it was an entree salad, and asked for the shredded beef on top, and I wanted some Thousand Island dressing. And granted, Thousand Island is not the best for you either, right? It's just ketchup and mayonnaise pretty much. But in some, do they have relish in it too? Not important. But yeah, so I was like, okay, excited, the salad itself comes, and it's a decent salad. I'm chewing away at it. And I'm like, okay, this is awesome. This is fine. But I'm like, wait a second. Where the hell is my dressing? I look. I'd already thrown the bag out into the trash, which is right below me by my left leg. I pick it out of the trash. I'm like, nope, no dressing in here. I'm like pulling up the paper because like the salad had a piece of paper. I was like, okay, well, maybe it's somehow like magically underneath here. Nope, nothing. Forgot the damn $1,000. I was livid. So I'm eating this like I'm a goddamn dinosaur. That can only eat herbivore, can only eat plants. And well, it's kind of a shitty metaphor because there was technically meat in it, but you guys get the gist. Like, I was just eating grass at that point. I was kind of pissed. The salad itself is great, right? But like, dude, come on. I was just like, really? Like, it was kind of a long day. All I wanted was a goddamn some dressing. But anyway, there's that. Let's take a look at this next decade. So Johnny, thank you for sharing this. The investor relations team, I'm not sure. Yeah, I'm hearing a box of leaves. Not fun. Let's pull this bad boy up and see what it looks like. Hopefully get the volume up. Yep. Yeah, I just realized that might be proprietary music, but check this out. It might not be copy free music. That's what I mean. But yeah, check this out. Like, I don't think people truly recognize how far this is at, right? And yes, I don't actually like romaine hearts. Well, romaine hearts are fine. I prefer spinach and arugula personally. So if I go to like a salad place, But anyway, specifically about this, I don't think people truly recognize. Like people are like, oh, but Tellurian. It's like this is where some of this misinformation can really sideswipe because they're like, look what happened to Tellurian, and I don't want to see what happened to Tellurian happen to this, and anything. It's like, but you have to realize Tellurian was like a complete different stage, right? Tellurian, they got past the Tellurian stage back in like 2017, 2018. Like that, the stock is at a different place than Tellurian. And so I think a lot of people are just sitting there like, oh my God, it's never going to actually be like ready. And, is it ever going to, it's like, these guys are much, much closer than you think. You can see Train 1 here showing up really, really well. And you can see the two tanks, both of the caps now. I don't know if they share the second one with the second cap being up here, but I mean, they've made great progress over the past several years to really get this into a place where it's very different than what you're looking at with something like a Tellurian or something like that. Like this is actually being done. And I think people don't fully recognize that. And so you can just see the progress that's been made. This is specifically Train 1 here that you're looking at. And I think to the left, I don't know if they share it, but there's going to be Train 2. So it's a big step in the right direction. And I think that people truly haven't given them the credit in which they deserve yet. And yeah, so I'm cautiously optimistic that in time, people will truly start to understand really what's going to be happening here. And it's going to be soon enough where they're actually going to get started on Train 3. And the back end, I think all the procurement already has happened for so yeah, you can see that you just saw the frame for Train 2 as well. Yeah, I don't think people fully comprehend it, but yeah, my hope is that within some time, I wouldn't be surprised if actually you see this operational before the end of 2027. The hope is that second half of 27 they have first gas. So I'm kind of curious to see when they're actually going to start commissioning things, because I feel like if it was me, right, I would, and granted, I don't know how their facility works, right? I would anticipate they have shutoff valves where you have a dead leg, meaning like an area where you have no communication and you literally like have a flange or something like that is literally unable to move gas or molecules or anything beyond a certain point. And I would anticipate that they would have a dead leg between Train 1 and 2, and they would have a dead leg between Trains 2 and 3. And so my hope is that independently, once you're finished on Train 1, you could get to a point where you might be able to actually start commissioning Train 1. But granted, I think Trains 1 and 2 are going to be happening on a very similar timeline to each other. And now that I'm kind of thinking about it, maybe I just bring up the actual presentation that they shared rather recently. And I think so that's the FID presentation. I think they might share progress in this. Let's see. Sorry, guys. I'm about to flip through this really quick. So if you guys are like prone to seizures or something like that, I'm being serious. Like I'm not trying to make a joke. If you guys are like prone to seizures or something, like maybe look away for a second and I'll say when we're on the slide. Because like the last thing I want is somebody to like have a conniption. So a lot of this beginning part of this slide pack, we're not there yet, so apologies. A lot of the beginning part of the slide pack is really about Train 5, obviously, because this pack was coming out specifically for that. And one of the things I definitely want to do, sorry, you can look at the screen right now for a quick second. There's a lot of debt on this, but part of it is project debt, right? Like the overall project has debt that is attributed to the entire Rio Grande project, in which NextDecade owns a portion of, right? So if you think about this, there's this entire phase 1 piece of Rio Grande. Next Decade is not obligated for any of this. I don't think people, let me repeat that. Next Decade is not obligated for any of that. Okay? Are you listening to what I say there? They're not obligated for the debt associated with this initial Rio Grande Phase 1 piece. And why is that important? It's because they were carried, right? Why do they have a lower equity percentage? Next Decade presented this opportunity to the partners, Mubadala, Total, etc. And that's why they have a lower equity share. They're being carried, what we call carried in the biz. In the biz. They're being carried. And so that I think is what people need to recognize is like they don't have an obligation. So what they're getting, yes, they still have to pay, interest and stuff like that at a project level. So there's obviously like they're split from the project, but as Next Decade as like a separate entity, they don't have to pay interest, if that makes sense. It's really when you get to trains 4 and 5. So I really want to break this down because you have like $20 billion worth of debt on this, but not all of it's going to be attributed to Next Decade. So if you look at this as like its own sort of company, it's tough. Now, granted, Rio Grande is being operated by Next Decade, so it's still very important. And obviously, they have there is a piece of it that, if you think about it, like they at a project level they own it, so technically, like they own that business. So technically, yes, it's like pseudo on their sheet, but like when it comes to after they get paid out their distribution to Next Decade from the project, they don't owe somebody else, if that makes sense. Versus like this Train 4 and 5, you can see at the very bottom, Train 4 LLC, Train 5 LLC, and this debt portion here. These 3.8 or so, this is associated with funding the trains themselves. But then you have this secured line of credit, the 1.2 here, and the 1.46 in the middle. That is what they're on the debt. They're on the hook for. So when you think about it, yes, the project itself, right? Still, it's like you owning a business, right? You own a business that runs itself. If the business itself goes belly up, you know what I mean? Like, depending on how you structure the business, of course, the bank can't come from you personally for liability, right? As long as you meet all the, normal, like you did everything that you could, right? It's the business that has the debt. You don't have the debt, right? So it's kind of the similar thought process. Now, if you say go on margin to invest in the business, that's when you yourself have debt. And that's kind of what happened with Trains 4 and 5, right? That's why they have 50% 40% initially going to 60% in Train 4, 50% initially going to 70% in Train 5. So it's a lot. It's a web, right? And so I get it. That's part of the reason why, I think people get so caught up. But yeah, let me see if they have more information on. Sorry, going back for Whiplash. See if they have any information on progress. So close your eyes, I guess. And maybe this explains it, right? This slide particularly. The middle here shows Rio Grande LNG project level. The whole thing, right? It includes Total's part, includes Mubadala, Saudi Aramco's part, includes like that particular piece of the business. The revenue that's generating, the EBITDA that's generated from that 3.7. Then you have the project level interest, right? Not Next Decade particular, right? They own a portion of it, but it's not specific to them, right? It's at the project level because that's just how it's structured. They pay the debt off with the business's income, right? And then you have what gets passed through as the Rio Grande project's distributable cash flow. And then you basically get the equity share going out to Total, going out to whomever, right? And then you get the Next Decade portion, right? This is what we care about. We care about the 0.7 to 1 billion. When I talk about it, I don't talk about the 3.7 billion because I don't care about the 3.7 billion. Yes, the 3.7 billion is important, and at the project level, very important. But what I care about when we talk about the business is this 1 billion in terms of distributable cash flow, which is still true. And then you have this interest payment, right? So that's what you need to focus on, right? Is this piece right here? I guess this bottom third of this is what's most important. This kind of goes into like, okay, yes, you have a business that you're investing in, but unless you personally take out debt, the business has its own debt. It kind of takes care of itself. You pay through the debt with the business, but unless you say buy shares on margin or say fund your own, equity portion of that business through your own personal debt, you don't have any sort of personal obligation. And that's what I mean by next decade's portion of the debt, right? This is that 200 million in interest that they're going to have to pay associated with that. So hopefully that makes a little bit more sense. It doesn't look like this particular presentation has that percentage, but this is back in August. So this is a little bit later. Actually, before I pull that up, let me check if the one from September has it. Updated guidance, overview, investor highlights, regulatory. Here we go. So I'm glad I checked this instead. Corporate deck. Is it this one? No, that's August. Share this instead. There we go. So this is September. Let me zoom in a little bit. So this is a little old now. They didn't update this particularly for the October presentation. You can see where we're at, right? With engineering, you're pretty much all done with all the engineering that needs to be done and all the stuff that needs to be procured for trains 1 and 2. Now it's literally just construction at this point. So we're already a quarter of the way. I just assume we're a quarter of the way in terms of construction. So in terms of overall, you're halfway through trains 1 and 2. You barely have gotten started on train 3. And the way they have this is like there's steps, right? So if anybody that has ever done like engineering, Gantt charts or anything like that, they have specific steps. And each of those is broken up in an amount of hours, expected, etc. And that's how they get the percentages, right? So like each piece of these, whether it's like for engineering and procurement, maybe it's separated into capital or something like that. That's done. But the construction piece is probably broken up into hours. So yeah, that's the reason why you're starting to see these percentages. But yeah, I think that I honestly think that you're probably going to get something mid 2027 in terms of output. So within the next, I don't want to say 18 months, but within the next 18 months, you should be expecting an imminent startup. So in the next 24 months, I feel you should be comfortably ready. So by the end of 27 is when we were expecting. Second half of 27 is what they're expecting. So I wouldn't be surprised if by early to mid 27, we have an imminent startup where they're talking about it. So, but anyway, I had to break some bad news to you guys. Some really, really, really bad news. And that is, I messaged our friend, Stephen Fiorillo. And I said, Steve, people want the Milkman. People are looking forward to the Milkman coming online. The people are looking forward to getting off of Matt's stream and on the Steve stream. And lo and behold, Steve said no bueno tonight. Steve said, I know that is what you want. And I know that is what people in the chat are expecting. But it doesn't look promising for Stephen Fiorillo to join. So I just want to say I'm sorry. I'm sorry on behalf of Steve. And like, of course, I'm going to be the one that gets, rocks thrown at him because I'm the one breaking the news. But if you guys could have a glass of milk for Steve. But anyway, I wanted to let me see if he'll at least answer the call. If I at least get him for 5 minutes. Give me 2 seconds. I at least want to hear him and hear his voice. It's going to be on mute. I know it's on mute. Guys, good news. Steve hasn't read anything. He saw some headlines. But good news is Hot Steve said he'd be more than happy to join for 5 or so minutes, but he's got some stuff that he's got to do. So unfortunately, he can't stay long. But at least we can get the Milkman on. I want to hear his thoughts and see his reactions because, I value Steve and I really want to see what he said. I didn't want to expose him, right? Because sometimes Steve and I say some shit to each other. So, we're buddies. Right? We chat a couple times a week. So yeah, I just didn't want him to say something or I say something and it just be out there. So appreciate you guys' patience while I was muted there. We didn't say anything bad. I probably could have had it unmuted, but excited. We'll see what Uncle Steve has to say. I'm curious what his thoughts are. It's raw reactions, right? He literally said he's in the coffee shop. He's exhausted. He just got home. So it's 7 something for him. He had a late day. He told me he might not stream earlier, which is why I told you guys that. Seems like he might still. I don't know. You guys can get him in the chat and say, why the hell aren't you streaming? But yeah, I'm curious to see his first impressions. I value his thoughts. It wasn't muted. You heard it all? Did you guys actually hear it all? Or is it muted? By the way, now that I have 100 something of you guys in here, 170 of you guys, much appreciated, firstly. Second, if you haven't seen a midstream ad, so obviously you have an ad when you click and join. If you haven't had a midstream ad, please put a 1 in the chat. And then 2, I just want to check. So I haven't gone back and listened to the stream personally, but you got me. Yeah. Damn it. I fell for it. But I've been trying to tweak the audio. So if the audio seems like it sounds a little bit better than it has in the past, not that I had bad audio per se, and ignore the fact that I have a loud ass laptop that you might hear a fan clicking. I got to get that fixed. I might get a new laptop. That is what it is, and I can't avoid that. But as long as the audio sounds slightly better, it sounds more full, sounds more full-bodied, doesn't sound as tinny, please let me know. My hope is that the audio continues to get better, and I downloaded something to hopefully make it sound a little bit better. So yeah, the hope is that it sounds a little bit more podcast quality. So people that are listening, get a little bit better of a sound, because the last thing I want is bad sound. I'm trying to improve it, but of course, you got this loud ass fan on my laptop. I don't know what's going on. I need to, I think, take it apart and blow it out. So, but yeah, curious to see what do you guys in the chat think of what the earnings looked like? I haven't had the opportunity to look at everything. It looks like obviously Chipotle took a deep dive. Meta took an impact. Obviously Microsoft took an impact. Google looks like it's trending in the right direction, over $2.90 a share. Can't believe it, but there we are. So hard to believe that I'm literally up like 100% on a lot of my shares, and over 100% rather. Speaking of what's not good, somebody messaged me yesterday like, "What do you think?" And I'm like, "I don't know, man." Speaking of not good, my God, shout out to the friends who stayed away from this one. And some people, man, they still like. I just think it's a boggy area, and I hope people that invest in it do well. I don't want anybody to do poorly. But yeah, that one. It seems like they had a good turnaround. It seemed like the earnings went in the right direction, but I just don't know. It seemed like they beat on the quarter, but it sounded like maybe the outlook wasn't as firm. So that might have been why, particularly, Enphase did not look so bueno in terms of it. But yeah, I've been trying my best to let people know, like, I was not, a fan when it was in the hundreds, and was trying to help people out. In my opinion, of course, this is my opinion, was not the stock to own, personally. And I stayed away, and I've stuck to my guns on that one. But, hopefully you guys are able to do whatever you need to potentially turn it around and make some money on that one. Like I said, I want everybody to get a W. I don't want anybody to do poorly. What other stocks did well while we're waiting for Hot Steve? It looks like crypto itself is taking a pretty big dip down. Curious to see as to why. So maybe we'll pull that up really quick. And it looks like it's accelerating. Let me just refresh here and see if it's just because I haven't refreshed. Sometimes Robinhood, yeah, it looks like it's accelerating downward. So it was at the 111, 112, and looks like over the past hour and a half, it is really just on a bad trajectory. Maybe it looks like it's getting some relief back up to 110, but no bueno overall. No bueno. Did anybody buy anything? Yeah, Quantum did do well today. I saw that. Do you hear that they shouted out on the Google call the quantum scientists that they had, like the head of their quantum? I thought it was pretty interesting. Found another guy talking about $1,000. I do know him. I've checked out some of his stuff. I think it's interesting, and I think he does a good job. Be very cautious, though, right? Like, when you're talking about some of those things so far out in time, you have to realize that you put discount rates on and stuff. And so if you don't know what discount rates are, right, you're going to get in trouble. So for Dustin's latest video that I saw, this was like a week ago, right after Train 5 FID, you have to realize he's putting a 13% discount rate, right? So when he's saying, for example, let's just say he says, okay, I'm doing cash flows out to and estimates out to 2035, let's say, at a discount rate of 13%, and the stock is fairly valued, right? What that basically means is he's discounting all the cash flows out for 13% annualized. So if basically the way I interpreted it as is, if you think you can find something that is going to get you a 13% rate of return, or whatever your risk is that you have on that annualized, then it's fairly valued. And so you could almost assume like between now and then, yes, there's going to be deviations from it, but between now and then, hopefully it's a 13% rate of return over that time period, which isn't bad, right? You think about it. He had a 13% discount rate on, I think it was like trains 1 through 5 or something like that. I'm trying to remember. And it was like a $9 valuation or something like that, being that potentially undervalued. And that was at a 13% discount rate. So if you think about it, even if you were buying it at $9 at a 13% discount rate, so to me, it's like you're probably going to get higher than that. Yeah, you got to think in that respect, like, you're not just putting inflation in there at 2%, right? You're putting 13%. So, in terms of your cost of capital and discount rate. So, and for anybody that understands NPV calculations and everything like that, when you have an NPV of 0, that doesn't mean you lose money, right? It just, NPV is an opportunity cost, right? So for anybody that's paying attention, stay with me now, because it can get complex. When NPV equals 0, the internal rate of return is equivalent to the discount rate. So you could say I have an NPV, let's say 20, meaning a 20% discount rate of 0. That still means that if you were to invest at this, you'd make a 20% rate of return. But the reason why you have an NPV of, say, 20 is, let's say you're comparing it against something that has either 20% rate of return, or your cost of capital is going to be 20%, or you're including overhead costs or something like that. So let's say you're just saying, okay, well, we're going to have overhead costs or whatever. So I need to have the 20% NPV discount rate. 20% discount rate on my NPV because of X. Then, technically you'll break even at that point, because discount rates are arbitrary, except if you kind of have an idea as to what you're doing them for. So when he was saying, oh, the stock price is like $9 or whatever at a 13% discount rate, unless you have cost of capital or something at 13%, it does make sense. We got to use that with a grain of salt sometimes. We have somebody extremely regal, knowledgeable, good looking, not yet caffeinated, but will be. He scoots into his chair. He's looking at his desk. He's giggling. He may or may not. He's smiling even more now. He may or may not have a glass of milk in hand. I don't know. I can't see his hands. Oh, he's looking around. Nope. Arms in the air. Stephen Fiorillo.
What's up?
How are you doing? You want to be on the left or right?
Do I care? Am I Tevis? No.
You're not Tevis. You're not a baby.
I'm not a baby.
Yeah, I'm talking to you, Tevis.
I have to be on the right.
I don't like that. That's too close. How are you, man? I'm happy you're here.
I'm happy I'm here too, Maddie.
We're going to give you the spotlight.
Why would you do that?
Because everybody's here to see the good looks of Stephen Fiorillo. Very curious.
True. Why have you been streaming for 3 hours and 46 minutes?
I listened to all the calls. I listened to Meta. I listened to Google. I didn't have the opportunity to listen to Microsoft.
Okay.
What are you chewing on? What kind of gum?
I just had a cookie.
What kind of cookie? You can't withhold that from the audience.
It's a homemade cookie.
Stephen, you're a legend. Anyway, I'm curious your thoughts. I know you don't have a lot of time.
Well, before we get into that, I just want to say something to Chef Paul. That I'm breaking the rules. I got cappuccino.
That was a great show last night with you and Chef Paul. I liked it. I like Chef Paul a lot. He has a lot of like takes, but he's like, so he has chef arrogance, which I enjoy.
Oh, yes.
But like not in a bad way, right? Like, you got to stand firm, right? So I really enjoyed it, and I hope that that's a regular segment. And I really enjoyed his takes, and obviously he's not just gonna like fall over on a sword. He stood his ground on some things, and I learned a lot. So
wait till you see him and I discuss movies.
And I'm with him, by the way. Oh, I want to see that for sure. And I'm with him, by the way. Like even like a frozen pizza in the oven, like is it the best? No, but you're still gonna eat it.
Yeah, I'm a little disappointed hearing the whole Costco pizza thing from him, but
When duty calls and you have no other time,
when you're in a pinch, right? When you're in a pinch.
when you're in a pinch, I'm not running out like after the stream. I'm not jonesing for a Costco pizza, but sometimes you got to do it. Okay, so let's get your raw reactions. What have you seen? What do you know? You saw headlines, but
So I listened to the Fed call on the way home. I only saw the headline information for Meta, Alphabet, and Microsoft. I was absolutely shocked that Meta sold off because they had to pay taxes. Now, unless there's something in the call that I haven't listened to it, I haven't read the press release, I haven't read anything. I just saw the headline news, and it looked like they got clobbered because they had to pay taxes. Like, ridiculous. And if it falls further, I could be talked into buying more. It's just ridiculous.
I'm a shareholder now.
You and somebody else are now shareholders. You guys are now on the train.
Yeah, I don't know. Did Amit have it before?
Not saying who, but somebody's a shareholder. Somebody else is a shareholder now.
Oh, what can we not say Amit on stream?
I don't know what's public, what isn't.
Oh, he shared it on X. So
so then he's
yeah.
Yeah.
He's him saying he bought a share. I don't know how much he bought. So
I didn't. We talked on the phone. I didn't ask him.
Okay. Yeah. Sorry. I appreciate you saying that because you don't know what's public sometimes. Well, you just don't know what's public sometimes.
Yeah, I don't know what's public. I'm not going to say a name. If I
appreciate that. No, I appreciate that. But no, he did put it on X. He didn't say how much he bought, but he did say on X, and that influenced me while we were listening to the call to buy a share. One share.
So that influences you, but me telling you that this thing's a home run.
Well, it's down 9%
for years.
For years, you're not wrong. You're not wrong on that.
Anyway.
So I'm with you. Yeah, I was hoping that they had a little bit more detail. They said it was obviously associated with the big beautiful bill. And in the call, which I need to re-listen to because I was distracted. I was tweeting. I was doing others, but I was still listening. They said it was about infrastructure that they no longer can use as much. And I was like, well, that's not a tax item. It seemed like that's like a write down. That's different. So I'm like, is it a write down or is it a tax impact?
Well, it's probably tax impact because they missed horribly on EPS. So I think it's a tax impact that went against profitability. But once again, I have to look through it.
Yeah, and I was hoping that they would have it. So I'm assuming they'll have it in the 10Q, but the 10Q is not out yet. So, but it was not in the press release at all, except other than like, hey, we would have been X or Y on EPS. Okay, other news.
Other news, I'm thinking about getting Chinese food for lunch tomorrow.
I'm thinking about getting Chinese food for dinner, but
I'm already playing out my day tomorrow as I took the day off. So
tomorrow?
Yeah.
For Amazon earnings or for what?
No, I got to use vacation days. I have used, I think, 2 vacation days this whole year. Yesterday being the first one I've used in like 6 months. So I legitimately need to use vacation days. So I was like, all right, I'm going to take Tuesday and Thursday off this week.
I love that.
I think I'm going to take Tuesday off next week.
Might as well. You got to maybe instead of Tuesday, maybe you should find out what earnings are next week. Maybe you should look at that first.
Next week, Palantir's next week, isn't it?
Tuesday. That's right.
Ooh, I'll take Tuesday off. Yeah.
I think it's Tuesday. Yeah, I'll be in the UK, so I need to figure out that'll be nighttime for me.
You can have some tea and crumpets.
They're in the morning or they're in the afternoon? No, they do in the afternoon now. They used to do it in the morning. Now they do it in the afternoon.
Tea and crumpets for Matt.
Tea and crumpets for your boy. Microsoft / Google. What do you think?
Microsoft, I saw slid on what looked like really good numbers on the top and bottom line.
Phenomenal numbers.
Alphabet freaking crushed and it went higher. So
17% ops margin year ago quarter for cloud to 24%. And not done. Not done, right? I mean, you climb, what is that? I'm not good with math, Steve, but 6.5% ops margin in a year's time. Insane.
Do you think you could change the view and get me out of like being almost the whole freaking screen?
It's the Stephen Furlow show.
No, obviously it isn't. You've been going for almost 4 hours.
But what does it say? The net income cloud, 85% growth. I mean, that's the reason why I personally started to take a big interest into Google.
What did search do? Did search slow? Did search grow?
There was something that decreased 2%, but search overall grew 15% in revenue.
So where are all the fears about search dying?
What
Search
was it?
dying. Search dying.
I forget what shrunk 2%.
I can't wait to talk to Roy. I want to see if Roy's finally going to change his viewpoint on freaking Alphabet after this.
Wait, Roy's a bear?
Oh, he's a perma bear on Alphabet.
I know he doesn't like Meta.
No, he's a perma bear on Alphabet.
Hmm.
I don't know if he's bearish, but he thinks search is going to be cannibalized. Come on, don't do that. Don't do that.
I'm telling you, man, people are literally using
That's
me
true.
as a waiting room for the Milkman stream to start.
It is not true.
So I don't want to hold you too long because I know you worked all day and I don't want to hold you.
Well, no, I need to finish this article.
Yeah.
That it needs to go out at 9 a.m. tomorrow. And
An important article. Tell people what it is.
Huh?
It's an important article. You do it every week. Tell them what
it's
it
my
is.
it's my weekly article.
Yeah. Tell people what it is, though.
The dividend harvesting series. It comes out every Thursday. Gotta get
Every
it done.
Thursday.
And I told Tanner that I would do something with him later, and then you called. I'm like, well, I can't say no, so I came on. We figure out how to make time.
We figure
just
out how to
sleep
get it
less.
done.
We just sleep less. That's all.
Steve released week 242 last week. He's going to release 243 tomorrow. For people, Steve didn't do a phenomenal job, so I'll do it for him. He's invested at this point. What is it? $24,200, Steve. Tomorrow will be $24,300.
Yeah, in $100 increments.
Insane.
$100 a week building an income portfolio from the scratch.
Insane. So you buying more on any of this, or are you just playing even keeled as normal buys?
I need to figure my life out, Matt.
Yeah, you do. I think you
We
do.
have so many things going on. Like Nvidia hit 4 trillion and then 5 trillion in the same month.
Was it both
Think
this
about
month?
that. Think about that.
Jesus.
Like, what are we doing?
I don't know. I mean, I remember selling it at 130. I'm an idiot. So. But Steve, I have some news for you.
Oh, news is good.
And then I'll let you go. Guess what they talked about on Fast Money today?
What did they talk about in Fast Money today? No, they didn't. Don't say it.
Say what? What
Don't tell me they talked about QXO.
talked about QXO?
No, they didn't. Did they?
No, they didn't. They didn't. They didn't. Before I move on to rubbing it in your face as a victory lap, what did you think of what's important out of the Fed news?
What was it? Debt next or freaking VG? Which one did they talk about?
Debt.
Huh?
It was debt for people going into negative free cash flow, remaining free cash flow, I'll say.
Oh, so pulling off the balance sheet to pay. They talked about that.
Yep.
I'll have to find it and listen to it.
I'll send you the clip. It was very, very interesting, and I was like, "Holy shit!" I was like, "I'm not crazy."
He's on to something.
That is on to something, but it's different, right? Oil and gas companies' return on invested capital is like,
Oh,
at
dude,
best,
Exxon and Chevron are so undervalued. It's disgusting.
they are, but like the return on invested capital for those companies is it takes years for that to show up. It's much quicker for tech, so it's a similar analog, but it's different, right? So. But I think I don't think it's getting talked about enough. But anyway, I want to hear your thoughts on the FOMC and what you thought was more important, the cut or the
I thought Powell
quantitative.
sounded like he lost his best friend. No, seriously, like no disrespect to Powell, but he sounded so blah. Like he normally doesn't have any emotion, but this was just like so monotone, and it wasn't freaking hawkish. And it wasn't dovish. It was just so blah, the whole thing.
What do you think is more important, the quantitative tapering or the cut?
The cut.
Why?
Because QE does not matter for entrepreneurship. What the hell are we going to do with unemployment going up? Like, the only thing that matters, like, I'm serious. I don't care about QE because I don't think it's that huge of a problem. What I think is a problem is interest rates being at a level where people still don't want to borrow to start businesses and try something, because we're at a point where more jobs are going to be lost to robotics and AI. And I want to see new companies built. I want to see more jobs out there for the American people. That's my biggest focus. Everything else will figure itself out in the free market.
So you don't think that this is artificially going to help push down rates as well?
Maybe.
I don't think that people are fully understanding. Like, they were cutting the amount of, like, they were letting a lot of roll off the balance sheet. We're talking about trillions over the past 2 years rolling off the balance sheet that now is going to be reinvested back in the treasuries. That's going to push down, just like we saw throughout 2020, 2022. It's going to push down the interest rates.
You need interest rates to get to 2.5%. Because that's going to trigger the 30-year to reside. And quite honestly, at 2.5%, you get a good economy. You get banks making money, you get more loan originations, you get a better spread on NIM, and you get businesses that are more inclined to borrow and expand, and you get more people that are likely to try to start a business because you're not paying freaking 6, 7, 8% on a business loan.
Interesting.
And I mean, I've always been there. I mean, look, the Fed has a dual mandate. And to me, while both are important, if you have to pick between the two, I'd rather pick stimulating the economy to spur more jobs, because eventually inflation will figure itself out. Because if there's not enough supply and too much demand, guess what? Companies will step in to make money and it will figure itself out. May take a couple months, but you'll get more supply one way or another. If there's a way to make money, people will go that route to make money.
That's why they're paying you the big bucks, Steve. All right. Well, I don't want to hold you up. What's for dinner tonight?
I got, I think I can get this article done in a good hour if I buckle down. So let's go to 8:15. Unless you're trying.
No. I'm gonna get something, but I'm happy that you're able to get on. I was hoping that, and I think this is something we needed to think about more. Is I was hoping that I was live and then you would do your show. But when's your show with Tevis?
No, I'm doing it. To me and Tanner are going to do something, I think, at 9:15 or so.
Oh, Tanner. Okay.
I may do something afterwards. I may do a little late night stream tonight.
Oh, a little late night with Stevie.
Late night stream. Well, I'm
little milk and cookies with Steven Fiorillo.
I'm home alone.
Oh, okay.
So maybe a little late night stream. Maybe I can sleep in tomorrow. I'm gonna black out the freaking windows.
I thought you were gonna say blackout on milk.
I'm gonna black out the windows so no sun can get in.
I love that.
Sleep until 10, and then I'm gonna stream.
It's wild for you, Steven, because you don't sleep in on Sundays.
Dude, I did sleep in on Sunday. If I do say so myself.
That's true. The boss lady went to go get the milk.
Listen,
I'm live in 2 hours. I want to do that.
10:30 or 11, man.
What am I getting for dinner, Steve?
I mean, you know what I think Maddie needs? I think you need to go sit at the bar at Morton's and go get a steak and have a nice glass of wine.
I don't think you're wrong, Steven.
I don't think I'm wrong either.
I might get picked up by a cougar, though.
I mean, listen, there's worse things that can happen.
Is that so wrong?
Worst things that can happen. Go call yourself an Uber, because we don't condone drinking and driving. Go get a nice steak, have a nice glass of wine. See what happens.
The Wendy's patties are good. I've done that. Just get the patties, no bun.
What is going on with Wendy's patties? That's what Tanner said he was having. He's like, I gotta go to Wendy's and get patty. I'm like, you can make food, right? How hard is it to make a freaking burger?
Well, he has no excuse. because he's at home.
Exactly.
And he streams, but he doesn't stream, I don't think, as much. Well, he did stream a lot today.
This is what I said to him. Like, dude, I went to the office. I was in meetings all day, worked on projects, came home, started writing. I'm going to stream with you and finish an article. Said, and you're younger than me. I'm like, what are you doing?
Hot Tanner. He's a good man. He helped me out yesterday.
He's the best.
I wasn't in a slump or anything, but I was just like, I need life advice.
Life
WWTD.
Dude.
What would Tanner do?
I told you what Steve would do. A glass of wine and a freaking ribeye.
Oh, it wasn't about food. It was about just like.
I get it. I'm just telling you what I would do for the night.
Yeah, maybe you're right. Maybe I'll look. I'll let you know what I end up doing.
I mean, is it really that bad of an idea?
It's not, actually. I wouldn't mind getting out of the house.
You know? Maybe get a little Stag's Leap or something.
Stag's Leap, what's that?
Ooh, go to the website.
Is that a drink?
Oh, it's some, you know.
All right, Steven. Well, I appreciate you.
You know, their Cabernet is freaking amazing.
Oh, it's a wine? Okay.
Oh, yeah. It's a winery out in California.
You're the man. Well, I'm I didn't see that. Ray, thank you for being a member for 5 months. That's awesome.
Is it your birthday, Matt?
No, it's not my birthday.
Oh.
Did somebody say happy birthday?
Yeah.
Where?
Somebody said happy birthday.
No, not my birthday. But I appreciate you coming on, man. I'm gonna end it here, and people want to know. Maybe this will tee you up for later.
I didn't watch it. Well, I can tell you Ohtani's the best baseball player that ever lived, even if people don't want to admit it.
Steven's the best baseball player that ever lived. But cool. All right, you guys rock. Please be sure to be on the lookout for Steve's article tomorrow. Curious to see how many dividends have come in. A lot of dividends from between last week and this week.
Do you want to see the numbers? I have them up.
Well, I don't want people to ruin. I don't want to ruin the article.
Articles? No, I can show you my charts and stuff.
Okay.
It's pretty ridiculous. Hold on.
Hot Steve does a good job. You guys got to watch it. I'm curious to see what Meta's doing. What's Meta doing? Meta's recovered. I'd sell my one share and retire.
So this is what 2025 looks like so far. I've had 4 weeks that generate over $100.
35.
And then if we go to, hold on. This graph's probably better.
I love those graphs.
So this is the monthly since inception. I mean, look at last month. I mean, 1251, I started in April. 1251, 47.96, almost 88, 141, and then basically 210. It's a lot of dividend growth year over year.
It's a lot. Big milestone for me was when I was averaging over 1,000 a month. That was like a huge thing for me.
Yeah, and just wait. This is on $100 a week, and I'm plowing everything right back in.
Love that.
It's 106 positions, 107 positions.
What are we buying in there? Everything?
Hold on. Let me show you. This is my favorite table. Hold on.
New section, 1 through 10.
So think about this. So this is the top 10 positions. Mo, I have a 5% rule where nothing can be above 5% in the portfolio and no sector can be above 20%. I haven't added to Mo since February 2024, so it's been a year and 3 quarters. I started with 18 shares. I mean, not started, but I actually purchased 18 shares, and I'm up to 22.53. It's already generated $227 in income this position. and you look at stuff like O, I mean, I don't know. It's pretty interesting. So the top 10 positions have generated almost $1,400 in income since inception. And this is an interesting top 10. Mo, Realty Income, Enbridge, QQQI, Verizon, Starwood, BST, BTI, JetQ, and PDI.
Steven, you're a businessman. That's why they pay the big bucks.
That's why they pay you. Listen, if I had your money, I'd donate mine.
You say that, but
no, it's the truth. The truth, my friend. You just don't
all right.
want to
Well,
believe
what's that?
You just don't want to believe it.
You're probably right. Well, I appreciate you, Steve. Thank you for stopping by. I'm glad to hear we're kind of aligned on what happened with the Microsoft, Meta, and Google earnings.
Did Meta really rebound?
Back to 700. It's not like
right.
it's
To start.
But I can retire now.
Did anybody make any data center announcements that they're, going gangbusters? Did Sindar do anything today?
Oh, Meta said that that's what their big money.
No, but what about Google? Did they do anything?
Yeah, they said that they're increasing capex for the year from 85 billion to 93 billion.
This is going to get silly.
And that goes back to what I was saying, right? Like they're making 130. They're going to be making 130 billion by the end of the year, right? Like on their trailing 12 month in net income.
Yep.
Or sorry, cash flow, right? Cash flow from operations. But you think about it, it's like they promised investors are going to be buying back 70 billion worth of shares. So it's like, okay, well, 90 to 90, 91 to 93, that plus 70, that's 160 billion. You're already above your cash flow from operations. So you have to dip. They're talking about potentially increasing above next year. They didn't guide for it, but they talked about in a later date they're going to guide for it. And then they have the dividend, which I think is $10 billion a year. So it's like,
keep in mind, they're taking a page out of Apple's book where Apple wants to be net cash or cash neutral, which is never going to happen.
Yeah.
So if they use 50 billion of cash off the balance sheet over the next couple of years, I don't think that anybody's going to care.
I don't know. We'll see.
Maddie will care.
I care. I'll still buy Google. I hope people freak out. I hope people are like, oh my God, this is horrible, and they sell it. And I'm able to buy it back again below 200.
That'd be nice.
See? Hot Austin knows. Cool. All right, my man. Good luck. You're the man. I'm looking forward to your stream. You said Tanner or Tevis or both?
Tanner.
Okay, you said Tevis earlier.
No, I was making fun of Tevis because I didn't want to be on the right.
Yes, we did do that. But then you said I thought you said you were streaming with Tevis later.
No, sir. You've been streaming for over 4 hours. I think you're getting your names mixed up.
You're probably right. And then after you said that, you said Tanner, and I just wanted to clarify that because you said once with Tevis, once with Tanner. I just wanted to clarify that you meant Tanner. When's you said 9:15?
I think so.
An hour from now. So good luck.
Something like that.
Cool. You're the man. All right. Talk to you soon.
You're
Thank
good,
you,
Romo.
everybody.
Let me go
You're good,
know where
Romo.
to go for dinner. I want to know.
All right. You're the man.
Later.
Thank you, everybody. Bye.